Hello, 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 hello. Hello, 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 hello. Can you please confirm if the audio and video is clear? Can you guys please confirm if the audio and video is clear? Okay, so a very, very good morning and a very warm welcome to all of you, and welcome to this wonderful subject. And this is your financial reporting exam oriented batch covering your entire curriculum. And first of all, thanks a lot for choosing us, and I hope you're going to have a very fulfilling journey covering this wonderful subject. So before we progress, a quick confirmation on the audio and the video. Is everything under control? Can you yes, perfect. Great. So, a very, very good morning and welcome to this session. Now, before we jump into financial reporting, which is a big ocean, and we've come a long way, starting with bookkeeping and accounting to going into accounting, then advanced accounting, and here you are at the pinnacle, the grand finale. You're now going to do financial reporting, and this is a wonderful subject. I mean, you're going to understand, and we're going to focus on a lot of treatments, the whys behind each of these adjustments, on why we are doing a particular adjustment in a particular way. And my objective over here is to change the way you look at accounting and financial reporting. It's a very practical, interesting subject. We will try to understand the concepts. We will focus on uh, everything in terms of concept building, but at the same time we will also ensure that your exams are in sight. So if wherever required, along with the concepts, we'll also give you clear streamlined steps. So we'll first do a quick introduction about the subject, then about the faculty, myself, and thanks for choosing me. And after that, we will just discuss on how we are going to progress with this batch, what are the resources that are available, what will be the resources that we will use, and then we will jump on into the course. Okay, so your breaks. Okay, so that is perfect. So the first query that is there in the session is, when will we get our breaks? Understandably, you want to structure it, but that's a good start. So your breaks would be at around, your proper break would be at around 1 o'clock, where you will have around a 35 odd minute break. And between that, we will have short breathers, let's say after, during the session. So you largely have a 2 hour session on either side. So that will be around 11 to 1, and there will be around approximately 1:30 to 3:30. That will be a proper break in the middle. And other than that, during these 2 sessions, we'll have short 5 minute breathers in the middle, so that your momentum is restored. Okay, so great. So we are off to a great start. So the first question we have is a question about breaks, but nevertheless. So we will first discuss about this subject. This is your paper number 1, and without any doubt, the biggest among all of your 6 subjects. In terms of the sheer size, it is, I mean, neither this DT or AFM or IDT kind of come close to this paper. It is approximately, I would say, I would rate it as a 150 odd mark paper in terms of the size, but Institute has strategically placed this as paper number 1, so you don't have that last 1.5 day hassle over here. You are going to give this as a first paper, and hence you will start for preparing FR at least 6 days before your paper, and hence you will be in a position to cover the entire course. So your objective over here is to complete and cover the entire course. Unlike other papers which you have to squeeze in 1.5 days, you don't have that pressure in this particular paper. In terms of the level of difficulty, most of your financial reporting papers have been papers from the core institute curriculum only, because of the sheer size. A lot of students do not complete the entire course, and hence institute, even if they ask you direct questions, a lot of students are not able to solve, unlike a lot of audit papers or AFM papers or DT papers, which they have twisted and turned. FR papers relatively are not as complex, but they are quite wide and exhaustive. So when you look at your financial reporting paper, like every other paper in your CA final and now even in CA Inter, there will be 30 marks which will be dedicated towards MCQs. So there will be 15 marks into 2. There would be 30 marks that is dedicated to MCQs. There's no negative markings which is there in these MCQs, and there is a 70 mark descriptive, which is the same. There's nothing new over here, out of which question 1 goes in as compulsory. Most of the times in this compulsory question, you will have a business combination question or you will have a consolidation question. Either of these two will go in as a business. Just a second, please. Either of these two will go in as a business combination or a consolidation compulsory question. This will be 14 marks, which you will have to attempt. And between question 2 to question 6, you will have to attempt any 4. So that is a total of 56 marks over here and a total of 70 marks on a descriptive. You don't have any options in the MCQs. You do have options in the descriptive section. MCQs, to be honest, we will share with you an MCQ bank. There's an MCQ bank in your book. Other than that, also we have a very wide bank that we have ourselves tried to collate, and that will be shared with you as well. But do we need to separately practice the MCQs? My opinion is not necessarily. If you are able to get your core content in place, MCQs are generally a byproduct. Instead of solving it, you have 4 options which you have to select one of them. Even if you had to solve directly, here you are solving and then you are selecting one of the 4 options, and that is why we will have to focus on the MCQs. You don't need to do it separately. We will largely focus on the descriptive, and that descriptive will form the base for our MCQs. But nevertheless, I'll give you separate MCQ practice, and we will share MCQs as well, which you can separately practice. Okay, so in terms of the coverage, you have a teeny tiny index, I can say, of around 35 topics approximately for your finance reporting, arguably the longest index in all of your subjects. So, I mean, the course is so wide that even if institute wants to cover and ask from each and every chapter, it cannot. I mean, 35 chapters would mean approximately a weightage of 3 marks per chapter. That is when they will be able to cover. So that's not possible. You will have a 14 mark question, for example, for consolidation, enough weightage for, let's say, financial instruments. And hence, this is one subject where there is no certainty whether a particular chapter will appear in the main exam as well. And that prompts you to do your expert level predictions and analysis that this will come, this will not come. And like everything, what you predict is almost always wrong, and institute comes up with a set of surprise. The best way to manage this is to cover everything, and that is our target. Even in the exam oriented batch, our book is the same as that of the regular batch, and we will ensure that we will cover everything, every question, every concept, but in an optimum way, in a time optimized manner. So we'll see how to do that. But before that, in terms of the chapters, I would kind of break your entire subject into 2 main categories. One is what we call as the major topics, and one is what we call as other indices and theories. So when you look at major topics and other ind-AS / theory. So if I were to look at an approximately 114 mark weightage, because there'll be one optional question as well, so 100 plus 14. If I look at the 114 mark approximate weightage, I would say around half of it, let's say around 55 to 60 marks will come from the major topics, and another half, 55 to 60 marks will come, let us say, from other indices and theory. Now, what is the breakup over here? Now, you will usually have group accounting, which we call as consolidation, which includes joint venture, consolidation plus joint venture, and business combination. So this section will typically, in my opinion, come anywhere between around 20 marks, I would say, approximately 20 marks. Uh, the breakup over here is usually you get one question out of either consolidation or business combination in the compulsory side. So the other chapter comes for around 6 to 8 marks. So if I have a 14 mark business combination question, then some concept of consolidation will come for around 6 to 8 marks. Or if I have a 14 mark consolidation question, then a business combination concept will come for around 6 to 8 marks. This is typically the weightage. So let's say this is around 20 marks. Then you have the all important financial instruments. This is Ind AS 32, 107, 109. So this is financial instruments. This is Institute's absolute favorite. This is one topic which the Institute loves to ask you a lot, and I would expect at least a 15 mark, 12 to 15 mark weightage coming from the financial instruments section. Then you have the revenue and lease standards. So there is Ind AS 115, and then there is Ind AS 116. Ind AS 115 is on revenue, and Ind AS 116 is on leases. So over here, this will typically come for around 8 to 10 marks, whereas lease will come for anywhere around 6 to 8 marks. Revenue, so these topics have almost always come. Lease comes in most of the papers, but it has not come in all the papers. But I've seen all papers, they have consolidation or business combination, financial instruments, revenue. This has almost always come. Then there is share-based payment or Ind AS 102. This is like the ESOP accounting that you do. And this will also have approximately a 6 to 8 marks weightage. So if I go to see over here, approximately 55 odd marks, 55 to 60 marks get covered in these major topics. So a student says that I can only study these major chapters and still pass. My answer is yes. But is that a good strategy? A definite no. Okay. So over here, optically it appears that these are just 1, 2, 3, 4, 5, 6, and 7. It optically appears. So this, what I've marked, these are the major topics. But if you look at your books, there will be one shield, then there will be two question banks, volume 1 and volume 2. The entire volume 2 almost is made up by these 5-6 topics only. So it might appear to be 6 topics, but it is approximately half of your syllabus. And the entire volume 1 is made up of all of these remainder of these topics. So optically it might appear to be 5 to 6 topics, but it is not a good strategy, and they are the relatively more difficult ones. They are something that will come in the exam, but having just a focus on selected topics is not the best thing. This is something that you have to do properly, but not the only thing that you have to do. So over here, this is regarding the major topics. And when you look at all other topics, well, I would say they would comprise around 55 to 60 marks, where there would be some theory topics. So theory topics may be something like accounting and technology. There will be conceptual framework. So this will comprise around 4 to 8 marks depending on the institute's mood. And even ethics, I will not really put it as core theory, but let us say if I look at even ethics, these 3 topics will comprise of around 4 to 8 marks, and other Ind ASs. So if you look at all the other Ind AS, that will be around 50 odd marks. So this is approximately 50 marks will be kept for all the other Ind AS. So optically it might appear, oh, I have to study so much. However, the questions that comes out of these Ind AS, like a related party Ind AS or a segment reporting or a fair value Ind AS, are relatively easier. So in the major topics, the weightage is almost guaranteed, but the questions will be very tricky. But in the other Ind ASs, the weightage is not guaranteed. So out of all of these other 25 odd chapters, 25 to 28 chapters, maybe around 8 to 10 of them will be asked in the exam. So that's around a 1/3 probability of being asked. But if it is asked, the questions will generally be quite direct and quite solvable as questions. So that is your overall weightage. In terms of, I mean, within these also we will mark chapters as tier 1, tier 2, tier 3. Tier 1 is A category chapters, tier 2 are B category, and tier 3 are the C category chapters. So we will mark all of them, but truth be told, it is very difficult and it is not advisable to predict what the institute will do. The safest strategy to get an exemption and above is to do everything. And for FR, well, you don't have this 1.5 days pressure. So even if you do everything, not just the last day revision sums, you are still able to complete everything before your exam. So I'm not saying that you have to necessarily do that, but just skipping topics is not a good strategy, which I would not recommend. And probably this is the last time you're studying. Like we always say that last 15 to 20 years you have always studied, and for most of you this is kind of the last climax of your academic journey. After this, depending on how many years you want to work, you're going to work only, you're not going to study. So this is your farewell to the academic world. So let it be a grand farewell. Let it be something, let that mark sheet be something that sticks to you and something that you remember. Like for me, I was fortunate to get a rank in my CA final, and I will use the word fortunate because I've not come close to a rank, or even in my school or in my college, the division that you have, forget the school or the grade, the division you have, I was not even in the top quartile of the students. So that ways, I used to work hard always, but CA final is something that kind of gave me a very good kind of farewell to my academic journey. And I would wish and pray the same for you as well. Whatever past baggage you have, keep that aside. This is one exam where which is very different from all the other exams. Every time you have been just focusing on studies, you're studying, you are revising, you are giving the exam, and everything is done in a span of a few months. This is the first time where people who may be naturally gifted, may be working, may be distracted in their articleship and everything. So if we are able to push the pedal up, we have a very good chance. And year after year, attempt after attempt, we have seen this repeat. The number of first time rank holders in CA final is almost always very high as compared to an intermediate or something else. So that should give you with a good starting point. And remember, you should aim for the moon. If you just aim for barely scraping through, it's not the right thing. If you're getting a chance, aim for the moon and you have enough precedence in front of you. So over here in financial reporting, we would want to cover everything, and this is your broad exam and a paper framework. Yes. Okay. So when we are looking at the course per se, our batch would be an exam oriented batch, but the coverage over here would be similar to that of a regular batch. So we have just realigned the books a little, but all the sums which were there are there. In fact, this batch, the books that you have the maximum sums till date, in the sense that we have included everything all the way up to the May 26 exam paper. Okay. Yes, FR may also be targeted, and we will cover that on how to cover everything. See, an AI based question set, no matter how much, we'll give you certain practice, but the only defense that you have against that is good conceptual clarity. Earlier, what you would have is you have X number of sums, you refer this, and out of these the same sums will be repeated, which may not necessarily be the case. If a new sum is going to come, there is no one in this industry who can tell you that this is the new AI based question that is going to come. That is out of question. But we will definitely try to practice them, see, so that we are aware that what are the different types of questions that will come. But having a good conceptual base is the best safeguard. And full coverage, two things: full coverage and conceptual depth. If you are able to build that, full coverage is easy in the sense that you cover everything that is there, you don't leave a single chapter. And in terms of conceptual depth, how do you build conceptual depth? While you are preparing, you ask the question why more often. Most of the times we just say that what are the steps? How? No, you ask the question why. Why this treatment? Why this is at fair value? Why cost? Why cost or another whichever is lower? Why not like this? In the first revision, if you're able to do that, and we'll try to address a lot of that during the class itself. That is why I said I want you to move out of that mold of accounting where you remember a set of rules and progress. No, we would want to do more conceptual depth. And that is the best safeguard. So a lot of our students in the past have also said that that conceptual understanding helped them in addressing a slightly more difficult question. Because if a question is difficult, you have to kind of be uh, a little more attentive and put one foot in front of the other, do one step, then another step, and the dots will ultimately collect. But if you are just focusing on the same repeated sums, in a relatively easy exam you might go through, but that is not a foolproof strategy, because the institute, earlier the focus was on audit, then it moved to AFM. We don't know where it will move. I don't even want to speculate on this, but a full coverage with conceptual depth is the best defense out there. No matter what, is the best defense out there to address any kind of paper. Okay, so we'll be focusing on that, and we will not really feel very scared or anxious. In fact, we will be positive and optimistic that we are studying conceptually. So that is a high possibility that no matter what the paper is, we are going to do really well. Okay, so be mentally prepared, and we will address every nook and corner of your syllabus. Okay, so your batch over here is an exam oriented batch, and the resources that you have for this batch, if you have received the books, they will be there with you. Otherwise, we would have shared the soft copies if you have kind of purchased it very recently, and you will get the books in some time. There'll be one FR Shield. Now, this is our concept book. So when you look at this colorful book which is there, this is your FR Shield, where we have given all the concepts. So this is kind of your single point of reference for any conceptual understanding that you want to develop. So over here, for example, if you are looking at a particular chapter, let's say any chapter like inventories, for example, over here you will have a lot of concepts in a good graphical chart wise format. And then there would be the questions that you will, so all of these are concepts, and then these are the questions where these concepts will be applied. So what you are supposed to do is you are going to review, let us say, the concepts while you are doing it in class, as well as in your first revision, and then go to these sums. First the concepts, then the sums. First the concepts, then the sums. Then you refer this chart, then these sums. The moment you go to the second and subsequent revisions, that's fine. You can read the entire concepts first and then do all the sums. But in the first revision or while class preparation, we would suggest that you understand the concept and then apply that. So that is why we have given referencing to the concepts as well. So this is your shield, which has all the concepts. Other than that, you have two question banks, core volumes, where this is especially useful if you are taking the recorded class. You are, if you are taking the live sessions, then your preparation gets done along with the class in terms of your lecture viewing. But in recorded, you can use this thing which is there in your volume 1, where you can, where we have given you week wise how many hours depending on your target. Like if you want to complete the entire course in 3 to 4 months, this is I think for the regular one. There is also for exam oriented or fast track, where you want to complete it in 1 to 2 months, 2 to 3 months, 3 to 4 months. Let's say you want to complete it in 2 to 3 months, then you have to view the lectures 4 hours every day. So that's around 28 hours in a week. So in 1 week, this many lectures, then the test, these are the, so it's a very good way, especially for the recorded student, to ensure that they maintain their discipline and they have a target to complete. So that is there in your volume 1. Apart from that, there would be a revision planner for subsequent revisions, including the important or last day revision questions we have mentioned. This is for your pre-exam preparation. If you are giving 5 days, 6 days, 7 days, this is all there in your volume 1. And then you have the material. So volume 1 comprises of all Ind AS other than the major topics. So all your Ind ASs will be there in your volume number 1. And then when you look at volume number 2, it appears to be a fairly short. Like you have revenue, lease, share-based payment, financial instruments, business combination, consolidation. But this will cover everything in your additional major topics. So these are the two core classwork problems that we're going to focus on, and this covers everything in your RTPs, MTPs, past year questions, study material, everything up to the May 2026 exam from the Institute Library. You can just refer this and you don't need to review anything else. If there is anything new that comes up, there will be a separate folder of amendments or new questions that will be there in your Google Drive link where you are accessing the lectures, and in that you can review. We will put, like if you even see on YouTube, for every RTP or exam paper that comes, whatever the new questions or different types of questions, we put a separate video for the same, and depending on when your exam is, along with this book, you just have to refer those videos for the new RTPs or the PDF of the new sums, and you will be well covered. So these are the 2 volumes. There is a third volume which is more for practice. So this is volume 1. Then there is a similar volume 2. As we said, this is for all the major topics. And then you will have a practice book. In the practice book, we have added practice questions that you can do for your practice. These are based on concepts which are similar to that on the classwork. So there's nothing new. And in this, we have not shifted anything from an earlier batch into the practice. We have added this as an additional practice section. So your core questions, as what were done earlier, still remain. In fact, these have more questions. There are more than 1,000 plus questions in the classwork section, which all of which we will cover. And then there is a practice book where you have practice questions which are additionally included for your additional practice, including the MCQs that are there. These are the MCQs which are given if you see at the end. But other than these MCQs as well, we have tried, there will be additional MCQs for your practice, which we can share on Google Drive. But to be honest, you don't need to do all of these MCQs. If you have done the core content properly, the MCQ gets done well. So I will say that the practice book is a good book to do. But if you have limited time, even if you do it selectively in areas where you face a difficulty, that is sufficient. You don't need to necessarily do the entire book. But if you do it, more the merrier, more the better. Your core content comprises of the shield, which is the concepts, along with volume 1 and volume 2, which will give you completely exhaustive coverage of whatever is needed for your main exam. ICI MCQ booklet, yes, that is there. All your ICI MCQ booklet is there in your practice book 3. And over and above that, if you want additional practice, there will be a soft copy MCQ file which we will be sharing. And this is additional MCQ, not ICI MCQs. These are additional MCQs which, if a student wants to practice, you can practice that. But the ICI booklet, etc., will be all done over here. What about the disclosures in FR? Well, we have a separate file for that as well, which is relevant for the IBS exams. I will share that file. It is so the shield will have all what is relevant from an FR and IBS perspective. However, if you are focusing on core just disclosures, like what is sometimes tested in an open book IBS paper, for that we have a separate 100-page document. I will annex that along. It is not there in your shield separately, but that's a document which our students carry separately in the IBS paper. So from an IBS additional disclosure perspective, you can look at that. Shield will cover everything which is written from an FR and IBS perspective. But if it is additional disclosure, which is not relevant from an FR paper perspective, there is a separate around 90 or 100-page document which you can refer. So in your Google Drive, you will get an additional MCQ booklet and you will get an additional presentation PDF which is there. Along with that, what you will get, so there is a shield which is for concepts. So in terms of notes, what you have is shield, which is for concepts, which will be there in the hard copy format. Then there is volume 1, volume 2, which is your core classwork and your practice question banks, which will also be there in your hard copy format. Then there will be a volume 3, which comprises of practice questions plus ICAI MCQs, which will also be there in hard copy format. Okay, so in terms of your core content, if you have limited time, what is non-negotiable is these items. Now, additional, in terms of soft copy, you will have additional non-ICAI. These are additional MCQ for practice. So this will be on your drive, which will be, let us say, in a soft copy format. There will be additional disclosures. Again, this is for an IBS perspective, which is also in a soft copy format. There will be important questions that we update every year. So for 2026, there would be an important or LDR questions. For 2027, again, for both the exams, we will share a separate. Largely it remains the same, but there will be a small difference. So you can review that. and there is a super 149. So what I do is every year we have a super 149. So the best 149 or the most important 149 questions we share. Don't assume that. I mean, a lot of times it has happened in the past, but I don't really want you to assume that these are the questions that will come in the exam. No, I'm saying these are the most important questions and they cover the majority of the concepts. So the super 149 questions we will share with you on our Telegram channel, and it will also be there in the soft copy format in your drive. So this is when you are revising and you want to focus on the important questions. Well, we will have these important questions marked in your book as well. Like if you go to a, let's say, uh, volume 2, if you look at any question over here, let's say in revenue, you have this question which is very important. Let's say question number uh, uh, question number 25, 26, whatever. Let's say this is a question 30. It's an important question. So over here, we will mention last day revision, and there will be a QR code where there will be audio notes in Hindi as well as in English for your preparation. This will help you in understanding the question slightly better, and whatever the tricky points are there, I would have given you in a short audio note. It is usually 1 to 2 minutes. At max, in longer questions can go up to 4 to 5 minutes, but we have tried to cover everything in that short time frame. So do I need to hear all these audio notes? My answer is no. But if you are stuck in a particular question while revising, kind of scanning that and listening through any of the audio players really helps. That is a feedback we have received from a lot of students. Now, other than that, we will have 4 section wise tests. So we will share with you. You will write it and send us a scanned copies, and we will correct it and give you the necessary feedback, and 1 full portion test. So these tests will be shared with you, and it will also be kept on your drive. So if you're unable to write it immediately, you can write it at a later point as well. Though I strongly recommend that you do it. It is a 4 section wise test. You do it along with the batch, and the full portion test you can do it after your revision. So this is your additional resource. And in terms of videos and audio pods, so every topic that we do, each and every topic out of this 35, without any exception, you will have a revision video along with important questions. This is something which is very, very valuable, especially when you sit to revise. And I want you to have this word of caution in your CA final, because a lot of students come with a lot of unrealistic expectations. Till now, whenever you have studied, you have always studied, revised, given test, given the exam. Everything happening in a span of a few months, not even extending up to a year. But now when you do your FR or you're doing your AFM, you're doing your articleship, your exam is probably multiple months, if not a year or so plus. And hence when you sit to revise again, you tend to forget. And when you tend to forget, all hell breaks loose and you self-doubt, you start crying, and a lot of things that happen. But you have to absorb that that is going to happen. It is normal in the regular course. What you need to ensure is how do you manage this situation. So ideally, when you are revising, you will first review this revision video. So that, for example, there is a Ind AS 16 property, plant and equipment. It will be less than 1 hour. Certain simple topics will be a few minutes. Let's say investment property is 20 odd minutes. So you can review that video, kind of have a quick recap of the concepts, and then jump into it. So it'll be slightly better. And then when you go to the second revision and subsequent, things will settle down. But if you are expecting that everything you will be able to recollect in the first revision, that is very unlikely, especially if you have done the sessions or lectures a few years or months away. So the revision videos will be there on YouTube for each and every chapter with important questions. And what I've done is, I understand that you might not be able to watch everything on YouTube. I mean, you will do when you sit to revise, but the problem that I see students facing is you're not in touch with the subject. Once FR is done, you say it is done. Then you directly pick up in the study leave. So what I've done is, on Spotify, I've tried to have audio summaries again for each and every index, and these are in a few minutes. Almost all of them are less than 10 minutes. The bigger topics may go on up to 20 or 30 minutes at max. like a YouTube lecture for a financial instruments will go up to 4 hours, but an audio summary will be a few minutes. Revenue similarly will go for a few hours on YouTube, it will be a few minutes. So that will at least keep you in touch. So if you're waiting for a cab to come, or if you're waiting for your girlfriend to come, in that time you can be with me. Okay, I will be your companion, and probably you can quickly refer these audio notes on Spotify. There's a refresher series, an entire playlist which is created. I'll share that link with you as well. So on the video side, you can refer YouTube. On the audio side, there'll be Spotify. And if there are any notes, like we have prepared really good, crisp charts for, I mean, these are fabulous, around 30 odd pages. And we have tried to cover topics in all the major topics in a span of a few charts, like Ind AS 12 on income taxes in a single page, share-based payment in a single page. So when you have to revise, it's a bird's eye view, one page and everything gets done. So all of these notes we will share on our Telegram channel as well. So keep kind of update, and if possible do subscribe to these handles, so that you will get regular updates for your revision videos, audio notes, as well as your PDF notes. Okay, so that kind of covers. Let me see, you've put a few questions. Can you please tell the chapter names for 1 week which you will be covering? Okay, so we will be covering over the course of this week. We will try to cover applicability of Ind AS. We will cover Ind AS 16, that is property, plant and equipment, then Ind AS 38, intangibles, Ind AS 40, investment property. So this will be the flow over the next few classes. How far I have to revise my inter concepts? No, inter is done now. You don't have to go back to your intermediate. If you have revised, if you have done it properly, great. Even if you have not done it, I will assume that you have forgotten what you have done in intermediate. So we will do everything from scratch. So don't worry about that. Yes, you can have a word with the team for the practice question book. Though earlier also it was there in your material, just that it was not organized into a separate section. So you can just have a word with the team. Yes, for AFM also there will be same. There will be 4 tests along with the full portion test. I think I forgot to mention that during the AFM session, but it is the same pattern for both FR and AFM. I will just have, you can just have a word with the team. I think I'll just share you the number. If there is any queries, you can have a word at 79772 99310. Most of the students would have received the books by now, I believe. But if you have not, you can just have a word with the team. Probably you might have placed the orders recently, and hence there may be an issue. But if you've placed it earlier, definitely have a word with the team, and they will definitely resolve it immediately. Okay, so I guess that is the resources, but remember, all of these are at the end resources. In today's information age, you have no shortage of resources. You have shortage of commitment and time. You might not like to hear this, but this is the truth. And once you realize it, it is the best for you, because the moment you realize that, well, maybe there are a lakh of students giving exam in a particular attempt, but the people who are serious, not distracted, focused, that number is very less. And if you're able to kind of be in that category, remember, passing CA final is not as difficult. You have to score 50 marks in every subject. That is, you can go wrong every alternate question on a simplified way. You can go wrong every alternate question and still pass. The margin of error is massive. It is not like a IIT, JEE or a CAT exam where you need to score that 99.9. No, you have a huge margin of error. And the reason why a lot of students are unable to kind of navigate CA really well is they start a little late and they just focus on selective study. If you just start a little early, and I don't know, I mean, how far your exams are, but see, what is done is done. Don't carry that baggage. From today, at this moment, you are the farthest from your exam. Every day that goes by, you come nearer and nearer. So whatever is done is done. You can course correct and you can focus with complete attention, and you can do really well. So try to cut out the noise around you. I'm by no means saying that you kind of isolate yourself, don't talk to your friends. No, there's a lot of time that gets invested, and I might sound old school, but a lot of times that gets invested. This thing in front of you is probably who's going to take a lot of time. So if you buy back some time from your phone, you will be amazed to see how much time you actually have if your screen time drops. So just try to be a little more focused and channelized over these next few months that you have, and you will see magic unwind. Okay, so as you might have heard with wealth, that it compounds over time. The results of compounding are never seen overnight. The results of compounding suddenly magically give you over a longer period of time. That is the same way with your studies. If you kind of ensure that you commit to your own self that no matter what, I will open my books and do some self-study on a daily basis, even if it is for 10 minutes, the 10 will become 15, 15 will become 20, it will become 1 hour, and no time you will be in complete momentum. But if you kind of delay it, that, oh, I'm not getting a good 6 or 8 hour slot, I'm not able to study, that will keep on pushing. So ensure that you promise to your own self, and promise to me and your parents as well, who have put in so much for you, and that feeling that you will, once they see the prefix in front of you, is, I'm telling you, what you're working for. That entire source of inspiration, or all that you worked for, that feeling of happiness, the sacrifice that your parents have done, what you have done, it should culminate quite well. And I'm not saying that all of this will ensure that you will clear. However, if you can tell yourself that, well, you know what, I put in my best effort. If it still did not happen, well, it was not meant to be. But if you have that regret that, oh, I could have studied this more, I shouldn't have left this 4 marks haunted me, you don't want that pain. So you still have time. Give it your best and ensure that you make everyone around you proud, because this is one thing that is going to stick to your CV. Till now, whether you like it or not, you've always been lied to. That better do your 10th and life will be sorted. Do your 12th and this will happen. Nothing happened. Do your intermediate, you are set. Nothing happened. Okay, we are still in our articleship grind. But this is at one grand finale. This is your final CA. And if you do this properly, well, this is going to stick with you. This is going to stick with you. At least it stuck with me and my colleagues for life. It is going to stick with you for life. So if you're studying for the last time, why not? It'd be the best time. Right? See, section-wise test, we will give you designated times, like tell you which date this test is to be written. That is a scheduled. If you are unable to write, then you can write it later as well. We'll get it evaluated, but preferably if you do it simultaneously, that will kind of force you to revise, and it will force you to kind of be on speed. You don't have to score the highest marks, but you ensure that the test is like a goalpost where you use for the purpose of your revision. Otherwise, you will keep on pushing the goalpost per se. Old books, you can continue with the addendums, but if you want everything at a single place, then you can take the new books. Otherwise, your old books that you might have on your Google Drive, we would have shared the additional questions. You can just review that and you will be in a good position to start simultaneously. Okay. So that is about this course. A bit about your professor, KYC, KYP, know your professor. So over here, a bit about myself. I have kind of completed my CA with the rank in my CA final. Also my CS and my CFA. I don't know why I did CS, but everyone along me in college was doing, so I thought, why not? FOMO caught on and I completed my CS. CFA is something that I did consciously. C also is something I did consciously because I had a very keen interest in finance, and that is why I did my CFA. So these are the things I kind of studied, and very recently I did my diploma IFRS as well to kind of help in understanding IFRS much better, and I can kind of share that insights with you. After qualifying, I completed and went on into the investment banking teams at Morgan Stanley, and then I proceeded into JM Financial. All of these while I was working in investment banking, long hours, long nights, but a fairly good experience. But a question that really comes to a lot of people is, why would you leave investment banking and do teaching? Well, uh, I used to teach from a very early age, from an age which is younger than you. I used to, from my all my college, I've taught. I enjoy teaching as much as I enjoy anything in life. So I've been teaching since a very early age. I've taught kids from the third grade to the ninth grade while I was in college, and then later once I started working, I used to work really hard on weekdays, but on weekends I used to teach CFA because that was possible to be taught on weekends. CA required a lot more time commitment, but I've never left teaching. I don't know. I've been teaching full time since the last 15 to 16 years, but if I see my part time teaching, probably for majority of my lifetime I've been teaching, and I I mean, more than a teacher, I'm still a student to this subject. Every batch that I do, I get to learn so much from the doubts that you guys ask. So uh, put your doubts in the comment section and let us have a good time. So yes, I'll definitely share my insights regarding my time at Morgan, my investment banking stint, and we'll also give you a lot of practical perspectives on things that are happening, like the Rajesh Exports thing that is happening these days. It has a very clean accounting impact in the sense that how they use this accounting things to kind of cover up a few things. So we will even discuss that, a lot of practical insights. But after working for a few years, teaching got the better of me, and we started teaching full time. And since then, we've not looked back. A lot of things came by, classes, face to face, private tuition. So we went from private tuitions to physical classes, to online, to COVID, and here we are live with you. So, but all this while, love for teaching is something that is keeping me going, and I really, really hope that I can share some of the learnings that I've gathered during these years with you. And my mission over here is obviously that you score exemption plus, but you kind of see this subject differently. You enjoy this subject, and this is a very, very important subject. Okay, so even if you look at, a lot of you want to make a career in finance, the most important subject in CFA, whether it is level 1 or level 2, is the financial statement analysis. It is the most important subject, because if you are unable to read the financial statements, you're not able to do any analysis. And hence, this is a subject which is going to be a core subject for your preparation, for your understanding. It is something which is very important, and I'm sure we are going to have a good time understanding this together. Other than that, while I am not teaching, I absolutely love traveling, and I've been a fairly avid backpack type of a traveler, which is completely unplanned, unstructured. We go out for really long breaks with zero bookings, zero travel, just two backpacks that I and my wife have, and we kind of spend a lot of time outdoors. Adventure is something that kind of excites me a lot. Anything which is a lot coming with uncertainty is something that I love to do, and I'll probably share a few of my stories over the course of this class. And I do love swimming a lot. So I've been swimming since a very early age, and earlier I used to do pool-based competitive swimming, and now since the last 10 or 12 years, I've been focusing more on open water swimming. That is, we swim in oceans, we swim in seas, 5 kilometers, 8 kilometers, 10 kilometers, 12-kilometer races, and eventually someday I want to do kind of a channel type of a swimming, but let's say that is a long shot away. So that is a bit about me, and I kind of want to thank you first for giving me this opportunity and trusting me with probably one of the most important subjects and courses of your syllabus. And I really, really hope that I can do some amount of justice to the course that is there in front of us. Okay. So let's get started. Yes, we will target exemption in FR. FR is one paper where scoring exemption, I would say, is very highly possible, because the questions that we will come is largely going to be from the material only. Unlike an AFM or audit, where institute does a lot of twists and turns, even in FR they can do. But FR typically is a paper which is very difficult to complete. People are unable to complete 100 marks of their paper. In fact, I myself could complete 78 marks of my paper. I could not complete 22, and that is a memory that still haunts me. and I don't want that to haunt you. So ensure that you have a good writing speed in FR more than anything else. We want to complete the course as well. Okay. Yes. Thank you so much. And so any other questions, or we can dive into our content? What do you guys think? Start kiya jaye, nariyal toda jaye? If you have any other questions, shoot. Okay then, so here we go. Bhagwan ka naam liya jaye, and let's get on with our journey for financial reporting. Okay, so we'll go on into the first part, and this is more of an introductory initial applicability of Ind AS. So have you heard about Ind AS before? We have done AS earlier in your CA Inter, and now we are suddenly doing something called as Ind AS. Why do we need Ind AS? What is Ind AS? And to whom is it applicable? What do you guys think? Is it applicable to the bigger guys or the smaller companies? Okay, so Ind AS will usually be applicable to the larger entities. And why? Why do I need Ind AS? What was the problem in AS? CA Inter में हमने अच्छा खासा AS पढ़ लिया. What is the problem in that? Well, I mean, before we go into the actual application and everything, if let us say if we come up with a hypothetical situation, let's say you clear your CA final, and now you are allowed to travel. Which countries do Indians typically travel the most? What is your destination bucket list? Maybe. So maybe US, maybe Europe, UK. So Australia, New Zealand, Switzerland, etc. So a lot of these countries may be in your bucket list, and definitely you will travel a lot as well. So Europe, Iceland, Switzerland, kya baat. So okay, so we kind of, I think around 10 years back, this again after we qualified, we went for a 77-day complete backpack trip to Europe. We'll discuss that maybe later during the batch. It was a very, very life-changing experience. Just 2 bags, no bookings, everything. But nevertheless, so we see a lot of these things. What is the commonality? I mean, I've not seen a lot of you saying maybe a China or maybe a South Korea. North Korea is a big no, but nevertheless, see, the thing over here is, even if you are going for this 1 or 2 week vacation, you want to go to a country whose language you understand. What they speak. Like if you go to China, you don't know what you end up eating. You don't know their language. You don't know anything what is written. You are not very comfortable in going to a country which may be a good country, but whose language you don't understand, even for a 10-day vacation trip. Now, if there is a investor who is going to invest maybe millions of dollars, they would want to invest it in a company whose language they understand. What is the language which companies speak? Well, they speak through their balance sheet, and the balance sheet is usually prepared using accounting standards or accounting principles. Now, the problem is a US investor, an FII or European investor who wants to invest in India. If he looks at an Indian balance sheet which is prepared as per accounting standards, a US investor does not know accounting standards, and as a result, they would be a little reluctant. They would say that, okay, well, you know what, how will I know whether the profit is actually calculated as per correct, or correct meaning as per comparable principles. If I have to compare a company in India with a company, for example, in Australia, Australia is following IFRS. I know IFRS. India is not following IFRS. Probably I don't know. And hence, the natural elimination is to say that forget these companies, because we don't know the language which they speak, so might as well go into a country whose financial statements we can understand. And that was creating a big roadblock. And hence we said, well, you know what, let us speak the language which has been internationally used. And internationally, there's a standard called as International Financial Reporting Standard, called as IFRS. So in IFRS, we are going to cover this followed in more than 160 odd countries. So we said that why not move to IFRS? But IFRS requires a lot of stringent measurements, valuations, accounting principles, and maybe we thought that we were not as well equipped. So we said that, well, you know what, we'll apply this to the larger companies only because a lot of foreign money largely comes into the larger companies. The very smaller companies don't really get as much of the foreign money. So that is fine even if they follow accounting standards, because Indian investors do know that. So we have given IFRS to be applied to the larger or the bigger companies, and at the same time, the word that we are using is not IFRS. We are using the word Ind AS, which means we have taken IFRS, but we have not adopted it as it is verbatim. We have tried to make a few changes. We have tried to make a few alterations for certain treatments that we are not agreeing with. Like for example, okay, I can see that I want a trip to New Zealand, Sydney, UAE. Okay, let's first come back in clearing CA, and then we will ensure that your bucket list is completed. Let's come back. So over here, when we are looking at, let us say, Ind AS, there are certain treatments that we are not fundamentally as Indian regulators in agreement with. Like for example, if you remember in your CA intermediate, you had this thing of purchase consideration in an amalgamation minus net assets. If your purchase consideration is 120 minus net assets are 100, there's a 20 rupee difference. Where does this 20 rupee appear? Sir, this is called as goodwill. You're paying 20 more than the net assets. That must be for the reputation of the company, and that is called as goodwill. However, if it is the other way around, like 100 is a purchase consideration and 120 is the net assets, it's a negative 20. Where does this negative 20 go? Well, this negative 20, can you tell me where does it go? You're paying 100 for something which is worth 120. So where did you take this? Do you show this as a negative goodwill? Please answer in the chat here. No, we don't show it as a negative goodwill. Then what do we show this as, sir? We show this as a capital reserve. So if we were to show this, for example, as a capital reserve, this is a negative 20 shown as capital reserve. Now, why capital reserve? Well, there is a separate logic behind that we'll come to it. The logic over here is, this is the only place which is a profit on purchase. Remember, every time you do a profit, you sell goods, you sell assets, this is a profit on sale. Here you are purchasing something and you are recording a profit. So fundamentally we say such a profit should not be a part of your P&L. It should not be a part of distributable profit. That is at least what an Indian regulator is kind of believing. However, in IFRS, it's a separate school of thought. IFRS says that I will take this to the profit and loss account. As per IFRS, this will go to the profit and loss account. Now, as Indian regulators, we are not in agreement with this, and hence we created what is called as a carve out. So there are around 10 to 12 places where we differ from IFRS, and we have given a document. Even if you Google up, we will say carve outs between Ind AS and IFRS. You will see a document where there will be 10 to 12 places of differences between IFRS and Ind AS. So we're telling an international investor that, well, you know what, we are following IFRS only. However, there are certain areas where we are differing, and these are those 10 or 12 areas, and you can refer this carve out. So if you know IFRS, you know these 12 points of differences, well, you know what Ind AS is, and hence we don't use the word IFRS. We use the word Ind AS because we are converging, we are coming close to IFRS, though we have not adopted IFRS. We said no, IFRS might take it to P&L, but in India, quite literally they have mentioned that this might give rise to artificial restructurings, where people might try to create a profit by doing some restructuring and take that profit to the P&L account. So let it go to the capital reserve only. So over here there's a carve out. So there are certain places where there's a carve out. So we're trying to say that why is Ind AS needed? Well, because of international investors, they want to invest in the country, they need to know the language of reporting. Secondly, if let us say we are following the language, we should follow IFRS, but well, the IFRS is having certain areas where we are not in agreement. So we are creating those carve outs, and there are hardly 10-12 places where there are differences, and we will give those carve outs and we will name our standards as Ind AS. Now, these indices are applicable to the bigger companies because the smaller companies may not be able to afford talented chartered accountants like you, and hence they might take a local graduate or someone who knows AS, but a talented chartered accountant like you is very costly, and hence this is this is towards the bigger companies who can afford people like you, like Big Four, etc. And hence this is applicable largely to the bigger companies. Now, when you look at this numbering, this is just for our understanding. When you look at this numbering, it's a very weird numbering. After 1 comes 2, logical. After 2 comes 7. 8, 10, 12, 16. Where are the numbers in the middle? Why have we given, like AS was clean, 1, 2, 3, 4, 5, etc. In Ind AS, your numbers are slightly weird. In fact, it goes up to 36, 37, 38, 40, 41, boom, 101, 105. So from 41, you put a jump to 101, 105. Why? Well, because this is in line with international framework. So for example, your IAS 16, International Accounting Standard 16, becomes Ind AS 16. Your IAS 8, International Accounting Standard 8, becomes Ind AS 8. So then what is this? Well, IFRS is formulated by the International Accounting Standards Board, and somewhere in the year around 2002, 2003 or somewhere, they decided to change the name, and they said every subsequent accounting standard that will come will be called as IFRS. Earlier, the accounting standards were called as International Accounting Standards. After I think 2000, and I forgot the year, but somewhere in 2000, between 2002 to 2009, they changed the name to IFRS, International Financial Reporting Standards. So now recently there's a standard which came, which was IFRS 16. Now the problem is there is already an IAS 16, which is on property, plant and equipment, International Accounting Standard 16. And then there is an IFRS 16, which is on leases. Now in India, we say that both of them are numbered 16, and hence what we say is, when I look at 116 leases, that is nothing but IFRS 16. So anything which is 100 and something, like for example, you look at IFRS 8. IFRS 8 will become Ind AS 108, but IAS 8 will become Ind AS 8. So this is just for your understanding, in the sense that this is not going to be asked in the exam, but if it comes from an entire, the first 1 or 2 classes will be on YouTube. Later we will transition to the app. Okay, so over here, this is for IFRS 16. So this is why the names are different. In fact, this is to ensure that an international investor can easily locate the standards. In fact, the para numbers and everything are same as what is there in the International Accounting Standards or IFRS. So that is why we are going to keep it in a way constant. Are we clear with this till now? Are yes or no? Okay. So yes. Okay. So this kind of is the background behind the Ind AS. Now, as you said, Ind AS is applicable to which companies? We said it is applicable to the larger companies. Now, when we are looking at larger companies, how do you define the larger companies? Now, there was a roadmap which was given. Like the roadmap mentioned that Ind AS becomes mandatory from 2000 or it was optional from the year 2015-16. Now, the problem is if Ind AS is optional, not mandatory, no one is going to adopt it. So that voluntary application was a failure. It was a flop. Hardly did anyone move to Ind AS. So they said, well, you know what? We'll have to make it mandatory. And hence from the year 1617 onwards was the first phase where Ind AS became mandatory. So over here, they said whether it is a listed company or a company which is in the process of listing. What do you mean by process of listing? Like if I filed an IPO document, like you look at companies like Boat or a company like Zepto as we speak, they've filed for IPO documents, but they've not yet been listed. So over here, if it is a listed company or in the process of listing, or it is an unlisted company, remember this is only applicable currently to enterprises which are companies, like it is under the purview of Ministry of Company Affairs. General partnerships, HUFs, individuals don't have to follow Ind AS mandatorily. If they want to, they can do it at their own choice, but this is as per Companies Act, which is applicable. So if it is a listed company or an unlisted company, if they have a net worth, not sales, not profit, not anything, if they have a net worth of greater than or equal to 500 crores as per the last audited balance sheet date, then they have to mandatorily transition to Ind AS. This is your phase 1, listed as well as unlisted companies having a net worth of greater than 500 crores. Now, in the year 1718, the institute feels that more companies will be in a position to now understand, because they have a precedent. There are a few big companies who already prepared their Ind AS financials. Sir, what about taking notes during the class? Okay, now I'll just discuss this. I just missed that. So this is, remember, an exam oriented batch. So I will be writing a lot of stuff on the board. These notes will be shared with you on a daily basis. So you will have access to each of these notes. You don't have to write this again. Even during the class, there will be, before we progress, I kind of forgot discussing about this. So let us, even during the class, you will have you'll have topics. So what we do over here is, at the start, let's say revenue has close to 90 odd questions. We will mention the important or LDR questions. So these are important and last day revision questions. Within this, the bold questions are the ones which are the most important. These are super 149 questions. We will solve each and every question, not just LDR or important questions. We will solve each and every, if there are 85 questions in revenue, we'll solve each and every one of them. But certain questions which will, because it's an exam oriented batch, like a regular batch, what you do is, like, you are preparing a consolidation, we will make the schedule 3 format, we will do the postings. Here we will do it in a slightly more rough way. Like, instead of a schedule 3, we can prepare, let's say, a sample balance sheet which is there in a T form. We will focus on calculation of goodwill, minority interest, do the postings. We have the solutions also printed. So I will use that wherever I want you to solve along with me. In pen and paper, I will mention. Otherwise, you can do it in rough on your calculator and you can scribble. You don't need to solve each and everything, because if you do, that's great. But then, I mean, if you're doing a recorded class, you can pause, you can do it on your own. Even if you're doing a live class, you can do it after the session, but it will take you as much time as a regular batch does, because largely the difference between a regular batch and the exam oriented one is, we will cover all concepts, all questions, but we want to do it in a time efficient manner. So wherever I believe that I can just discuss and understand, you will understand, we will do that. Wherever there's numerical, I will always be solving on my note and I will give those notes to you. If you want to solve and you're looking at the live session, you can always mention the word try, and after the session you can try it on your own. If you're looking at a recorded session and you want to try it on your own, you can always pause and try. But other than that, in my experience, if you go with the flow in the class, understand things and then revise, you will be in a good shape. You don't need to note down everything necessarily, but if you are having that habit that you want to write, then you are most welcome. You can write as well. Okay. So over here, coming back, so when we are looking at, let us say, the net worth limits, you think will increase or will it decrease? Well, they say that if you are having a net worth of greater than or equal to 250 crores, as per the last audited balance sheet, 250 crores as per the last audited balance sheet, then you will have to follow Ind AS. And for listed entities, there is no limit, which means even if your net worth is 5 crores, but if you are listed, you will have to follow Ind AS, because a lot of FIIs, foreign institutional investors, will invest in listed stocks. So we want all listed companies other than those on the SME exchange, small and medium enterprises, though the SME exchange has no company which has a 250 crore net worth. So other than the SME exchange, where Ind AS is not mandatory, all stocks that you have heard about are all listed on the main exchange, not on the SME exchange. If nothing is given, you will always assume that a listed company is listed on the main exchange. So as we speak, all listed companies, irrespective of their net worth, will have to follow Ind AS only. And unlisted companies, if the net worth is greater than 250 crores, like Parle, for example, is unlisted. But if its net worth is, it is, as a matter of fact, more than 250 crores, then Parle will also have to follow Ind AS, because it's a fairly bigger company. There can be a lot of interest, like Haldiram. It's a fairly big company, and in Haldiram also there's a lot of private equity investors who want to invest. So we will make their financials as per Ind AS if the net worth is greater than 250 crores. Are we clear? Okay, sir, what about 18, 19, 19, 20? We are currently in the year 26, 27. Let us talk about that. Well, the institute has not given any further roadmap. They have said 17, 18 onwards. Sir, what does it mean? 17, 18 onwards would mean that from 17, 18, your net worth limits remain constant, in the sense that maybe your net worth on 31st March 17, 18, 19, 20, 21, 22, none of these years it crossed 250 crores. But in the year on 31st March 2026, let's say your net worth, 31st March 2026, let's say your net worth becomes 252 crores. then Ind AS becomes applicable. So this is the net worth as per the last audited balance sheet. You guys tell me, if my net worth crosses 250 crores on 31st March 26, what is my first Ind AS financial statement? Is it the year 26-27 or is it the year 27-28? Okay, so your first Ind AS financial statement will be the year 26-27. Sir, why not 25-26? Why not any other year? Well, because for 31st March 26, you completed your accounts and at the end of the year you saw, my net worth went up. Now you are not required to restate the entire set of accounts, and hence net worth as per the last audited balance sheet. So if your audited balance sheet as per AS gave you a 252 crore net worth, then subsequent to that, from the year 26-27, you will proceed on into preparing Ind AS. So this will be your first Ind AS financial statement. Okay. Audited financial statement not available. Well, for a company, audit is mandatory. So if you look at Companies Act, audit is mandatory. So you will have to get that audit done. So from that point, you will have to follow Ind AS. Let's say that is 26-27. Now there are a few more challenges to this. So 17-18 onwards. So the roadmap of 17-18 is applicable to companies in general, except for certain specialized institutions which are covered by other regulators like NBFCs, like banks, like mutual funds. Like NBFCs and banks are covered by RBI. Mutual funds are covered by SEBI. Insurance companies are covered by IRDA, Insurance Regulatory Development Authority. So for these, different dates are mentioned. From your exam perspective, though we will discuss about these companies specifically, from your exam perspective, what you need to focus on is the regular company. So the question says X Limited. So X Limited is not a bank, it's not an NBFC, it's not an insurance company, it is not a mutual fund. If it is, the question will tell you, and we'll tell you what the roadmap is. But otherwise, in general, you are going to follow for a company which is other than such a financial institution. Okay, so most of you, let's say if you are writing the November 26 exam, then the year that will come is 31st March 26 year. If you're writing the May 27 or the November 27 exam, then your year will be 31st March 27. 2028 exams, then your year will be 31st March 28. So the question will tell you that for the first time the net worth crossed 250 crores on this date. In which case you will say, well, that means you will have to follow Ind AS from the next year. So if 31st March 26 is the point where it crosses, then Ind AS will be applicable from the year 26-27. Are we clear with this? Okay. Now another problem over here is this net worth. If you remember in your CA Inter, there is standalone net worth and then there is consolidated net worth. According to you, which net worth are we talking about? Well, this is a standalone net worth, because for a regulator, consolidation is parent and subsidiary together. If I want to catch hold of a particular company and say that you are guilty, how will I do that in consolidated financial statements? Standalone statements, every company has a unique PAN number, they have a unique corporate identification number, and hence the net worth will be, that is right, it will be standalone net worth. So over here, the net worth over here can be calculated as your equity share capital plus your preference share capital plus, let us say, your reserves excluding revaluation reserves. So over here, this is the definition as per the Companies Act, plus the reserves excluding revaluation reserve minus any fictitious assets. What do you mean by fictitious assets? Something like an underwriting commission not written off, preliminary expenses not written off. All of these are not really assets. They are expenditures which are not yet written off, in which case you reduce them and that will give you your net worth. So you will do this on a standalone basis. So when we look at over here, your shield to apply this. So when you look at your shield, go to your shield on page number 1, please. Applicability of Ind AS, phase-wise applicability. From an exam perspective, this is a tier 3 category. C category chapter. From an exam perspective, very less chances of this coming in the main exam. They will ask you largely questions pertaining to Ind AS. They expect you to know, but it is not like the last phase where the applicability came was in the year 1718. After that, there's no changes. So unless there's a new phase that comes up, well, it is relatively less important from an exam perspective, but it is important that you know. Applicable for all entities except for banks, insurance companies, NBFCs, let's say mutual funds as well. If you want, you can write down mutual funds as well. For the year 15-16, it is voluntary application, a complete flop. Like for example, you have SPOM exams. You don't study it as seriously as you study for FR and AFM. Why? Because marks are not going to be counted. So if anything is to be done voluntarily, people focus less. So they moved on to mandatory application for listed entities or entities which are in the process of listing in or outside India with net worth of greater than or equal to 500 crores. Now, this is where, I mean, if you think in a lot of depth, it might create a bit of a confusion that you have written listed entities or entities in the process of listing in or outside India. In India, I understand. Outside India, ka kya lena dena? Okay. So, for example, you look at companies like Google, you look at companies like Tesla, SpaceX. SpaceX is doing an IPO. If you're aware, it is one of the biggest IPOs of recent times, and it's a very interesting IPO. It's a huge IPO, and उसमें उल्टे सीधे इलॉन मस्क है, वो तो कुछ भी कर सकता है. तो I mean, he has given performance targets that if he is able to set up a data center on moon, or if he is able to set up a civilization on Mars, he will get performance bonus shares or whatever it is. But nevertheless, so if you're a company which is like a SpaceX, which is in the process of listing in the US, or Tesla, which is listed in the US, कोई बोलेगा कि entities which are listed even outside India, Ind AS is applicable. It will be applicable if Tesla or SpaceX have to do reporting in India. They don't have to do any reporting in India. Remember, Ind AS is applicable to those companies which have to do reporting in India. Like, for example, if you have heard about a company like Naukri.com, which parent company is InfoEdge, or MakeMyTrip.com, these were early pioneers of internet. Like in the year 2000, when all of these waves were not there, they were formed at that point, and at that point Indians did not have computers, smartphones. So Indian investors did not understand how will people find jobs online, or how will people book tickets online. So Indian investors would not give money to MakeMyTrip or Naukri.com. So they actually listed, as a matter of fact, they are listed on the US exchange. But they are Indian companies, and hence the reporting happens in India. So if I'm someone like a Naukri.com whose shares are listed maybe in the US stock exchange, but I have to do reporting in India, that is when these companies who are listed outside India will also be relevant for the purpose of Ind AS. If I'm a company who is listed outside India, like Coca-Cola, USA, and who's not doing any reporting in India, does not really matter. Ind AS will only be applicable to those companies which are listed whether in or outside India and who are going to do reporting in India. Okay. Unlisted entities with a net worth of greater than or equal to 500 crores. So basically for the year 16-17, and this is not really important from an exam perspective because the current application is the applicability of 17-18 onwards, but from 16-17, any company, whether listed or unlisted, if the net worth is greater than 500 crores, then Ind AS has to be applied. However, if a net worth was less than 500 crores, then in the year 17-18, if you're listed, irrespective of the net worth, your Ind AS will become applicable. If you're unlisted, then if your net worth was greater than 250 crores, then Ind AS would become applicable. Are we clear with this? Okay, mandatory applicability for all listed entities or entities in the process of listing, irrespective of net worth. That is an important thing. Limits not applicable to companies listed on the SME platform unless given otherwise, your company is not listed on the SME platform. Unlisted entities with the net worth of greater than or equal to 250 crores. So these are your companies to whom Ind AS becomes applicable. Now, what do you mean by net worth? Share capital, equity and preference, both reserves, excluding revaluation reserve minus fictitious assets. Remember, goodwill is an intangible asset. Patent is an intangible asset, but not fictitious. Fictitious assets like preliminary expenses not written off, underwriting commission not written off, etc. Then you have limits are applied on standalone net worth and not consolidated based on the last audited balance sheet. Almost all legal limits are going to be based on standalone net worth only, because you are like income tax. If you review income tax, जो आपने CENTER में किया था, that income tax is calculated, tax return is made for every company. It is not made consolidated because every company has a separate PAN number. And for every PAN number, you can make an income tax return. And if there is some problem, the tax office knows which company or which PAN number to go after. Consolidated में तो यार 50, like Tata Steel has 600 subsidiaries. Who will you catch hold of? And hence limits are going to be based on standalone net worths only. Okay. Now let us say आपने जोश में आके इंडेस अप्लाई कर दिया. You said that okay, my net worth is not about 250 crores. I am not listed, but I want to report using latest framework. You prepared one financials voluntarily as per Ind AS. Can you prepare? Well, yes. There's no restriction in preparing Ind AS statements voluntarily. So you prepared a financial statement as per Ind AS voluntarily. Then you realize, oh, there's a lot of mess. Apna AS was better. Like for example, if you just look at AS9, छोटा सा cute सा standard था AS9. You hardly had let's say 15-20 problems, and it will get over in a day or two in your CA Inter. Ind AS 115 has close to 100 problems, and it's a huge standard. Okay, it's humongous. So Ind AS is a lot more. AS13 on investments, very small standard. Financial instruments, huge. So you made one Ind AS statement and then said, "ये हमसे ना हो पाई. I will not be able to do this. I want to switch back to AS." Okay, can you switch back to AS after preparing an Ind AS financial statement? No. Whether you prepared an Ind AS financial statement mandatorily or whether you prepared an Ind AS financial statement voluntarily, once you prepare a statement as per Ind AS, there is no looking back. Sir, but what if my net worth was 252 crores? Next year I made a loss, my net worth became, let's say, 200 crores. It is less. Okay, but if you prepare one financial as per Ind AS, it is a one-way street. You cannot come back. Whether you get delisted, whether your net worth falls, whether you voluntarily don't want to apply, it is okay. Point taken. So it is whether you voluntarily apply or whatever be the reason, you cannot revert back to Ind AS. So over here, when you look at this roadmap, we say that Ind AS can be applied voluntarily or it can be applied mandatorily. However, an entity prepares its financial statements as per Ind AS in one of the years, it is required to prepare all future financial statements as per Ind AS only. So it is a one-way street. If you were to apply this in Ind AS for one of the years, you cannot then revert back to AS. Now, that means there will be selected companies whose net worth is about 250 crores or who are listed are going to follow Ind AS. Now, the problem over here is, let us say we look at companies like Tata Steel Limited. Now, Tata Steel Limited is a listed company. Now, Tata Steel has close to 600 subsidiary companies. Most of these companies have their net worth which are, let's say, less than 250 crores. Let's say these companies are unlisted. So technically, even if Tata Steel follows Ind AS, its subsidiaries need not follow Ind AS. But this is where there's an additional clause. Like earlier in your intermediate law, it was taught that what is a public company? There were certain limits, but you were also told that a subsidiary of a public company is a public company only. In a similar way, here they say, like in your COVID, you remember if one person gets COVID, the entire house gets quarantined. This is similar to that quarantine principle, where if one of the entities in your group can be your parent company, can be your subsidiary company, can be your joint venture company, can be your associate company. If one of the companies in your group follows or is covered by Ind AS, kind of it is affected by COVID, like, then every person in your family gets quarantined. In a similar way, over here, if one company in your group, let's say Tata Steel Limited, goes under Ind AS, all of its subsidiaries, all the 600 subsidiaries, even if their limits are not met, will have to follow Ind AS. All of the associates are companies where they have between 20 to 50% stake, will have to follow Ind AS. All of its joint ventures, like for example, Tata Starbucks, or let's say Tata and Air India, for example, all of its associates, joint ventures, and even its parent company, like for example, Tata Sons is the parent company over here, all of these will have to follow Ind AS. Are we clear with this? So when I look at an Ind AS application, I will say that once if Ind AS becomes applicable to one of the entities in the group, it would become applicable to all other entities of the group as well, like a subsidiary, associate, joint venture, parent, etc. This is one of the most important clauses, and this clause kind of expands the applicability a lot. Like if one company in your group gets infected in a way by Ind AS, all the other companies, all the parent companies, all its subsidiary companies, all its associate companies, joint venture entities, all of these will have to comply with Ind AS. Now there's one small exception over here which we will review, which is regarding what you call as fellow subsidiaries. Like for example, there is Tata Steel Limited and then there is Tata Consultancy Services, TCS Limited. Now as a matter of fact, both of them are listed. But let us say for simplicity, or let's say Air India. Tata now owns Air India if you are aware. So let us say over here for simplicity, Tata Steel Limited gets listed. So will Tata Steel have to follow Ind AS? Yes. Its parent company, which is Tata Sons. वैसे net worth of Tata Sons is less than 250 crores for simplicity. Let us say it is unlisted. Will it still have to follow Ind AS? Please answer in the chat. Please answer. Okay. Yes, it will also have to follow Ind AS. All the subsidiaries, let's say S1 of Tata Steel Associates, A1 or joint ventures, J1, all these subsidiaries, associates or joint ventures, will they also have to follow Ind AS? Yes. Now the problem is fellow subsidiary. What do you mean by fellow subsidiary? This is like a co-subsidiary. Air India, let us say, has a net worth of less than 250 crores, let us assume, and it is also unlisted. Technically, will Air India required to follow Ind AS? No, but because its parent, that is Tata Sons, has to follow Ind AS, will Air India also come within the Ind AS purview? Yes. This is where they give that exception. They say that if your applicability is coming because your parent is following Ind AS, but parent's applicability is not its own independent applicability. Parent's applicability is a derived applicability. Listen to this very carefully. Ideally, Air India independently need not follow Ind AS. However, Air India is a parent company which is following Ind AS, so technically Air India also has to follow Ind AS. But the parent's applicability is not its own applicability. Parent's applicability is actually a derived applicability. Tata Sons has a net worth of less than 250. It is unlisted. It has a derived applicability. So over here, Air India is not mandatorily required to follow Ind AS. At least from a legal standpoint, it is not mandatorily required to follow Ind AS. This is a legal position. If it comes in the exam, this is what you have to say. Now, practically, there is a bit of a problem here because when Tata Sons has to prepare its consolidated financial statements, Tata Sons has to consolidate Tata Steel also, Tata Sons has to consolidate Air India also. Now, Tata Sons has to follow Ind AS statements, so it can consolidate Tata Steel, which is also as per Ind AS, but it also has to consolidate Air India, which is as per AS. So, consolidation teaches you or tells you that consolidation has to happen using uniform accounting policies. So, Tata Sons will have to restate Air India's financials into Ind AS and then consolidate. So practically what we have seen, most companies, what they do practically is they will voluntarily make Air India follow Ind AS. Air India के लिए Ind AS is not mandatory. However, they will voluntarily switch and say let Air India also follow Ind AS so that it is easier for us from the perspective of our consolidation. Are we clear with this? Okay, so when we look at Air India from an exam perspective, it's a fellow subsidiary, and fellow subsidiaries applicability over here merely because Tata Steel is applying due to which derived Tata Sons is applying, then Air India did not follow Ind AS. Okay, let us shift this a little. Let us say the net worth of Tata Sons was greater than 250 crores. Then irrespective, is Tata Sons, irrespective of Tata Steel, is its own independently? Does Tata Sons have to follow Ind AS? It has a net worth of greater than 250 crores or it is listed. Yes. In which case, now can Air India claim the fellow subsidiary exemption? No. In this case, Air India will have to follow Ind AS. Why? Well, because its parent company is following Ind AS. No, but the parent company's applicability, no, it is not derived applicability. It is its own independent applicability. And if it is its own independent applicability, in such a situation, will Air India have to follow Ind AS? Answer is yes. Are we clear with this? So I will again repeat, when I look at fellow subsidiaries, Ind AS is not mandatory if my fellow subsidiary is following Ind AS. No, but if my fellow subsidiary is following Ind AS, my parent will also have to follow Ind AS and thereby I will also have to follow Ind AS. No, that is derived applicability to the parent and hence I am still given an exemption, though practically people may voluntarily move to Ind AS. However, if the parent independently follows Ind AS, not because it is derived from a fellow subsidiary, then Air India will have to follow Ind AS. Again, if a parent voluntarily moves to Ind AS, not because of any derived fellow subsidiary pressure, Air India will still have to follow Ind AS. Are we clear with this? So when I look at this exception, let us review this. Point 4, and there is a special additional guidance. Point 2 on the next page. Next page. Ind AS need not mandatorily apply to fellow subsidiaries, fellow joint ventures, or fellow associates. Okay. However, parent may need to restate financial statements of that company for the purpose of consolidation. Like Tata Steel is following Ind AS, so its fellow subsidiary Air India need not follow Ind AS. However, the parent Tata Sons may need to restate Air India's financials for the purpose of its consolidation, and hence practically what a lot of companies do is they voluntarily make Air India follow Ind AS even though there is an exemption. But from a student standpoint, we will mention that legally you are not required to follow Ind AS. Sir, if Tata Sons had derived applicability but its parent company doesn't fall under criteria, should they follow Ind AS? Yes, if its subsidiary is having a derived, like the subsidiary of Tata Sons is following Ind AS, then Tata Sons has to follow Ind AS. Then there is no option. But Tata Sons ke different, the other subsidiaries of Tata Sons may not have to follow Ind AS. That is what we're trying to say. Okay, so this is pertaining to point 4. Achha sir, what if my company is not covered under the above roadmap? Okay, if it is not covered above the above roadmap, then you will continue to apply AS. Remember, this is only for companies. If you look at Partnership Act of 1932 or something which was there, they don't mention that partnerships above this level or that level have to follow. This is only for companies as per Companies Act and Ministry of Company Affairs. So over here, companies which are not covered by the above roadmap, that is their net worth is less than 250 crores or their net worth is less than 250 crores or they are unlisted, then well, they can very well follow AS. The above roadmap is not applicable for banks, insurance companies, NBFCs, as a separate roadmap is prescribed, and we've mentioned that over here, not really important from an exam perspective. Ind AS is applicable irrespective of the entity being a charitable organization. In Companies Act, if you're aware, there's a Section 8 company. Section 8 company is a not-for-profit company, but still the net worth may be higher, like an ISKCON, for example, is a Section 8 company. However, its net worth may be more than 250 crores. If it is a company, irrespective of whether it's a charitable organization or not, they will have to follow Ind AS. So a question might come that a company is a Section 8 company. Will it have to follow Ind AS? Your answer is yes. it will have to follow Ind AS. No, but it is not for profitable. Where does the law tell you that Ind AS is applicable only for profit making companies? If your net worth is greater, well, you will have to comply with Ind AS. Yes, if you're asking for the parent company of Tata Sons, so if Tata Sons also had a parent company, then they will have to comply with Ind AS. There's no exemption over here. The exemption is only for fellow subsidiaries, not for any other. It is just available for fellow subsidiaries. So your parent company of Tata Sons, if any, will also have to follow Ind AS. Okay. Now, point 8 we will do later. This is to be done along with joint venture. You will not be able to understand right now. There's a difference between joint operation and joint venture. We will come to that once we will do the joint venture or joint operation standard. So as of now, this is your base of applicability. When I look at NBFCs, the same roadmap as what is an NBFC. Achha, first of all, you should know the difference between an NBFC and a bank. A bank like a State Bank of India or a Kotak Mahindra Bank, etc., they have the ability to accept demand deposit. Like you can open a saving account, you can open a current account in a bank. In an NBFC, you cannot open a saving or a current account. In an NBFC, definitely you can put a deposit, like a fixed deposit can be put in Bajaj Finance or a Cholamandalam Finance or a Sundaram Finance. These are NBFCs, Mahindra Finance, but you cannot have demand deposits. You can't write a check, etc. out of your NBFC account. You can have at best fixed deposits. In a bank, you can have a current or a saving account. You can also have a fixed deposit. So a lot of people's hard-earned money is more put into banks because you get your salary, stipend, everything into a bank. And hence RBI is very particular, a bit finicky about banks. And hence RBI says even till now that Ind AS is not applicable to banks. All your HDFC banks, ICICI Bank, Axis Bank, everyone prepare their accounts as per AS, accounting standards. Loosely, in practical life, it is also called as IGAAP, Indian GAAP, Indian Generally Accepted Accounting Practices, RAS. Ind AS is based on IFRS. So banks still, even if your exam is 2028, 27, 29, banks are going to follow accounting as per AS only. Okay, what about NBFCs? So RBI took a chance with NBFCs. They said let NBFCs transition to Ind AS, and the transition roadmap is a +2 roadmap. Sir, what do you mean by +2 roadmap? Which is whatever you studied over here, +2. +2, like what was the limits in 16-17? This will be the limits in 2018-19. What were the limits in 17-18? This will be the limits in 19-20. So basically for an NBFC, if the net worth as per the last audited balance sheet went above, let us say, 500 crores, then, or they were listed or unlisted, then 2018-19 is the year where they follow. Or if there's any listed NBFC, Bajaj Finance, Mahindra Finance, Cholamandalam Finance, Sundaram Finance, all of these are NBFCs. If there's a listed NBFC, irrespective of the net worth from the year 1920, and if it's an unlisted NBFC, then if their net worth is greater than or equal to 250 crores from the year 1920, again, this is 1920 onwards. Beyond this, there is no roadmap given. But an important point for you to know is in an NBFC, voluntary application to Ind AS is not permissible. You either are crossing the limits, in which case you follow Ind AS, or if you're not crossing the limits, then even if you want to, you cannot follow Ind AS. Yes, okay. So over here for NBFCs, it's a +2 roadmap, 18-19 listed or unlisted greater than 500 crores, 19-20 all listed NBFCs and unlisted NBFCs if they have a greater than 250 crore applicability. Voluntary application is prohibited for NBFCs. For banks, deferred until further notice by RBI. Okay, and for mutual funds, again, this is for your understanding. Now, SEBI has allowed for all mutual funds or required for all mutual funds application from the year 1st April 2025. So 25-26 onwards, mutual funds have to prepare their financials as per Ind AS. So if you want, you can note down. So mutual funds, this is applicable. Again, there is no limits here. SEBI has given all mutual funds applicable WEF, that is with effect from 1st April 25. So from 1st April 25 onwards, for mutual funds, that is for your exams, whether it is 25, 26, 26, 27, 27, 28. If there's a mutual fund question, yes, a mutual fund has to prepare its financials as per Ind AS. Now, insurance company is the only thing that is a bit under a question mark because IRDA can notify something. So over here, when you are looking at an insurance company, these insurance companies, there's a new Ind AS which is coming up, which is Ind AS 117, which is based on IFRS 17, which is only for insurance companies. Now they have mentioned that currently IFRS 17 or Ind AS 117 can be applied voluntarily. Eventually, it will also become mandatory. Once it becomes mandatory and IRDA notifies, that is when insurance companies will follow this standard. As of now, from your study material and a practical standpoint, IRDA has not yet notified a date for a mandatory application. They have given voluntary application, but mandatory application have not given a date. So Institute has not mentioned anything about this. But insurance companies, we can say this is deferred until further notice by IRDA. If let's say there's a notification which comes up, we will share this with you on our Telegram channel, YouTube, as well as it will be all over the place. So you don't have to worry about it. But as of now, insurance companies are not covered under the roadmap. And even if Ind AS 117 comes, it is very, very unlikely that that entire Ind AS 117 becomes applicable for the student, because it is highly technical and complex. I know a CFO of one of the leading NBFCs, and he along with a lot of Big Four partners are racking their brains in understanding what needs to be done with 117. It is highly specific and it is only applicable to insurance companies. Like there are certain standards like exploratory mining, they're not there in your syllabus because they're highly technical. If 117 comes, definitely we'll put a separate video, but it will not impact anything that you study over here. So don't really get bogged down. If it comes, we will share that. It will be a separate standalone island and it will not impact anything that is studied. As of now, Institute has not given any notification, clarification or anything on its applicability. Okay, sir. So for a bank, deferred until further notice, banks cannot follow Ind AS. For an insurance company, again deferred until further notice. Mutual funds, Ind AS are applicable. Again, there's no limits given. For NBFCs, the limits are for your year, that is 31st March 2026. It is the same. If your net worth is more than 250 crores for an unlisted NBFC or it is a listed NBFC, then you have to follow Ind AS. Okay, now there can be a practical problem over here, that what if your group companies have insurance companies or NBFCs or banks, and there may be certain companies, like if I take the example of Future Group. Now in Future Group, which is run by Mr. Kishore Biyani, there's a company called as Future Generali, if you're aware, that is an insurance company. Or let us say Bharti AXA, if you have heard. Bharti Group is the group that owns Airtel or Bharti Infratel. Well, they also have a Bharti AXA Insurance, Tata AIG Insurance. Now the question is, if I'm a Future Group, let us say it's a Future Group, I have various companies. Like for example, I have a company like Big Bazaar. Now they've sold it, but let's say if I have a company like Big Bazaar, Pantaloons, all of these were earlier Future Group companies, but I also have a company like Future Generali. Now the question is, for Future Generali, in its SFS, what will apply? Well, SFS will be as per accounting standards only. I don't have a choice. It will be as per accounting standards only because it's an insurance company. Future Generali is an insurance company. So it will have to follow as per AS, but Future Group is not a bank, it is not an insurance company, it is not an NBFC. Then, I will look at its independent application. I will look at the net worth. Sir, net worth is greater than 250 crores. Let's say it is listed. So Ind AS will become applicable. Yes. Now comes the problem. For Future Group, independent. Remember, insurance application independent, NBFC application independent, bank application independent, mutual fund application independent. Irrespective of what is happening in Future Generali, I will say that I have to follow Ind AS because my net worth is greater than 250 crores. My other subsidiaries like a Big Bazaar, which is not a bank, will also have to follow Ind AS compulsorily. But does Future Generali, you guys tell me, does Future Generali, which is an insurance company, has to follow Ind AS? Answer is no. Well, they will follow AS only. Now the problem is when I do consolidation, I have to do consolidation as per uniform accounting policies. Ji haan, that is the policies of the parent. And as a result, over here for SFS, of future generally, I will follow accounting standards. But if I have to consolidate, then I will try to restate the financials of future generally to Ind AS to the extent practical, and try to consolidate with the future group. Like, this is a company which is based in India. I can have a subsidiary which is based in the US, which may follow US GAAP for its local reporting. However, for the purpose of consolidation, I will have to restate based on the policies of the parent to the extent practical. And if it is not practical to restate, then I'll have to mention a note in my financial statements that I'm unable to restate because of the following reasons. So over here, they can adopt voluntarily? No. NBFCs, banks, insurance companies cannot do a voluntary application of Ind AS. It is prohibited. So over here, when we look at point 3, in case there are banks, insurance companies or NBFCs in a group, they may continue under the accounting standards. However, for consolidation, their financial statements may be restated to Ind AS to the extent practical. Remember, for their SFS, voluntary application is not permitted as per the law. Are we clear with this? Okay. So this is regarding most of the things of this. I'll just complete the last point and then we'll stop for a break and we can do the sums on the other side. Is a particular thing which is there in your study material, but I don't really think it is important from an exam perspective, though there are around 3 problems that are there in the study material. It is for something which is close to more than a decade old and it is not really important from an exam perspective, but if it is there in the study material, it is our job to cover it. Now, let us say you are doing first time applicability in the first phase. What was the first phase? Sir, 16-17. Now, in 16-17, the limits were 500 crores. This is as per the last audited balance sheet. Now, the last audited balance sheet will technically be the 31st March 2016 balance sheet. However, you were at a time where you were suddenly going to go to Ind AS at one go. Now there is no precedent, there's no one who is following Ind AS, and now you have to mandatorily follow Ind AS. So they had put a cutoff date. So they had said, or the cutoff net worth. Your cutoff balance sheet date was 31st March 2014. Listen to this carefully. It's a little tricky. It is outdated, so I don't think it will come in the exam, but if it is there in the study mat, we will do it. So they said that if your net worth on 31st March 14 crosses 500 crores, then no matter what happens later, you will have to move to Ind AS for the year 16-17. Like for example, if I look at 31st March 14, your net worth was 515 crores. Then later, let's say on 31st March 15, on 31st March 16, your net worth keeps on falling. Let's say it becomes 300 crores, then it becomes 200 crores. We say it does not matter. Will you still have to follow Ind AS? You guys tell me. Will you still have to follow Ind AS? Yes, because either of this has to be met. So even if your last audited balance sheet was not under 31st March 16, you had a hardly a 200 crore net worth. But because on the cutoff date on 31st March 14, you had a 500 crore plus net worth, the law gave you a good 2 years preparation time. You are on 31st March 14, 14, 15, 15, 16, pura wait karo. And 16-17 you move. Sir, but what if my net worth falls? Let it fall. You did not know in the meantime that it was going to fall. So if your 31st March 14 net worth is greater than 500 crores from the year 16-17, 16-17 Ind AS will become applicable. However, if your net worth on 31st March 14, let's put it the other way around, was 200 crores. Then in the year 16-17, will Ind AS become applicable? No. Let's say later it becomes 300 crores and later it becomes 515 crores. Now for the year 16-17, will it become applicable? I will again compare the net worth as per the last audited balance sheet and net worth as per the cutoff date. If either of these two are crossing the 500 crore barrier, you will have to follow Ind AS. So over here, again Ind AS becomes applicable. It's a slightly weird provision. So you look at either the last audited balance sheet, which is 200 crores, or the cutoff balance sheet. If either of these two is greater than 500 crores, Ind AS becomes applicable from the year 1617. That is 200 or 515. Either of these two is higher, Ind AS becomes applicable. Now, I am not a standard setter. So over here, if I am not a standard setter, then yes, there is a separate one which is already recorded if you want in a different language. So over here, this is, let us say, Ind AS applicability, net worth. You will have to select either of these two. So when we look at, let us say, the applicability for initial applicability under phase 1, that is from 1st April 2016 onwards, net worth on 31st March 14 needs to be checked. If the company did not exist on 31st March 14 or net worth on 31st March 14 was less than 500 crores, we will continue to check Ind AS applicability based on the net worth as per the last audited balance sheet. So simplified terms, you will say that we will check the net worth as per the last audited balance sheet date or the net worth on 31st March 14 for the 16-17 applicability. Now, in my opinion, 16-17 applicability ke upar you will not get questions only, but it is there. 2-3 questions are there in the study material, so we will review that. So basically, for 16-17 applicability, you will look at either net worth on 31st March 14 or net worth on last audited balance sheet. If at either of these two places your net worth crosses the 500 crore barrier, then Ind AS will become applicable. Are we clear with this? Are we clear with this? Any problems here? If company is incorporated in the year 14-15, then you will have to look at the last audited balance sheet. Then there is your net worth on 31st March 14 is NA, not applicable. Then you only have to look at the last audited balance sheet. Perfect. Okay. So that's it about the applicability. We will now stop for a break and we can resume back by around 1:35 or so. If you have any other questions or queries, please feel free to shoot. Right now we are hungry. All queries will come after that. Nahi? Chalo. So we'll be back in around 35 odd minutes and then we can continue with the questions. Hello, hello, hello. So are we back? Hello, hello, hello. Perfect. Okay then. So we are done with our break. We are done with our lunch and now it is a time to go to sleep. Okay, so let's go on into the questions and let's try to complete this particular topic. I see that there were a couple of queries where you had students had regarding this cutoff date concept. So I'll just discuss that once. But having said that, I'm telling you this is only relevant for the year 16-17. Beyond that, not for the year 17-18, 18-19, 19-20. It is not relevant for any of the other years, and hence from an exam perspective, it is next to a nil chance for these questions coming. Having said that, there are around 2 or 3 questions. We will do that. But if you have a doubt regarding the cutoff date concept, the cutoff date concept means for the first time application on the year 16-17, ideally we should have looked at the net worth as on the last audited balance sheet, that is 31st March 16 only. Instead, the regulators, now for whatever reasons, they provided a stipulation that you will take the net worth as on 31st March 14 or the net worth as on the last audited balance sheet date. If either of these, on either of these dates, if your net worth was greater than 500 crores, then Ind AS would become applicable. My sense is it was because they wanted to give a lead time of a couple of years before Ind AS starts on 16-17. So if there's a company which from 31st March 14 itself knows that 2 years later it has to comply with Ind AS, it has a good preparation time. So that is the rationale for it. And for the company which was incorporated in 14-15, on 31st March 14, it was not existing only. So it will not have the net worth on 31st March 14. Its relevant net worth will only be the net worth as per the last audited balance sheet date. On 31st March 14, the company itself was not in existence. And as a result, for us, for such companies, you will only have to look at the net worth as on 31st March 16. That is the last audited balance sheet date. Will I be able to secure 80 plus if I attend the exam oriented batch? You will not be able to secure if you merely attend. Okay, so attending is one thing. You will have to put in a lot of efforts on your side, and if you're able to put in those efforts, 100% this batch or any other batch, whether it is regular or exam oriented, will definitely work. But it is, I mean, we are both in it together. So one is what we do, and second is what you have to put at your end in terms of coverage. This will prepare you adequately to attempt every question and score the best possible marks. Cutoff date will be given when, sir, for company. Cutoff date is, I mean, it's just a term that I am using. Cutoff date is a 31st March 14 date. So it is only for 16-17. If I have to check for application, then I will look at the net worth as on 31st March 14 or the net worth as per the last audited balance sheet date. We'll do 2 or 3 sums on this, and hopefully after that it should be absolutely clear. Okay. It depends. I would say that even if you do the exam oriented batch, that is sufficient. You don't separately need to do the regular batch, in my understanding. But it depends on what you are more comfortable. The coverage will be similar. Here we are just going to optimize both on time as well as, so we'll try to balance between the time and let us say the coverage. Okay, fair. So let's go on into the questions. So question number 1. So over here, as you see, these are the questions 6, 5, 6, 7, 8, which are relatively more important from an exam perspective, though this entire chapter is more of a tier 3 category chapter. Let us review this. Following is a snapshot of the audited balance sheet of a company A as on 31st March 2014. So this is the 31st March 14 balance sheet. Company A's equity shares are listed on the Bombay Stock Exchange since 2010. So it's a listed company, and you have this balance sheet: equity share capital, securities premium, general reserve, revaluation reserve, profit and loss and liabilities, fixed assets, investments, current assets, and miscellaneous expenditure not written off. As per the roadmap, which phase will company A fall into? For the purpose of Ind AS, you have the 31st March 14 balance sheet only. Will your answer change if company A is an unlisted company? So what we'll do over here is there will be certain questions where we will try to solve in fair, but there will be a lot of questions where we will discuss and solve it in rough. You don't necessarily need to solve it in rough. You can just do it on your calculators as well. The printed solutions are given to you, and wherever required, even the board notes will be shared. It is more important during this session that you have an understanding of what is happening, and if you want to separately solve on pen and paper on your own, you can always do that separately. Like over here, the important part is you want to calculate the net worth as on 31st March 2014. So what all will be there in net worth? Well, it is equity share capital 160 crores plus securities premium. This is 200 crores plus general reserve. This is 150 crores. Revaluation reserve will not be taken. Then there's profit and loss 75 crores. And then liabilities are not there. Then there are assets, but there is miscellaneous expenditure of 80. So this is an expense basically, which has not yet been written off. Not an asset, it is more of an expense. And as a result, your net worth, if you can quickly tell me what is the net worth, calculate and tell me. Well, this is 505 crores. So your net worth on 31st March 2014 is 505 crores, which means after that, come what may, will you have to comply with Ind AS? Yes. From when will you have to comply with Ind AS? From the first phase, that is 1617 onwards. Are we clear with this? Perfect. So you will have to comply from the first phase, that is 1617 onwards. Will your answer change if A is an unlisted company? No, your answer remains the same. Still, you'll have to comply since in the year 1617 only, because in the first phase, you have to, your net worth has to be greater than 500 crores, whether you're a listed company or an unlisted company. Are we clear with this? Any problems in this question? Okay, so this is question number 1. Then look at question number 2. Let us say in question number 1, the balance of profit and loss account is a negative 375 crores. When Ind AS should be applicable to company A? Will your answer change if company A is an unlisted company? Now, if I look at the net worth on 31st March 2014, this will be equity share capital of 160 crores. You can also do it directly, plus 200 crores of securities premium plus 150 crores of general reserve. Now, instead of a 75 crore profit and loss, there'll be a loss. There'll be a loss of 375 crores, and there's still 80 over here, which is a negative balance. So if I were to do this, this is 160, 200, 150 minus 375 minus 80, and you get only a 55 crore net worth. Now, if your net worth is 55 crores, will Ind AS become applicable on 1617? The answer is no. But the question is telling you when will Ind AS become applicable? Acha, in the first case, in the year 1617, will it become applicable? No. Why? Because the net worth is 55 crores. We don't know any subsequent net worth. So unless given otherwise, if that remains the same, this is 55 crores, Ind AS will not become applicable. But it is optional, right? What is optional? This is not optional. I mean, if your net worth crosses 500 crores, you have to mandatorily follow Ind AS. If your net worth as on 31st March 14 crosses 500 crores, you have to mandatorily apply Ind AS from 1617. There's no option in that. Option is if your net worth was lower and you still want to follow Ind AS, then there is an option. Okay. However, think and tell me, in the year 1718, will Ind AS become applicable? Let us say the net worth remains the same at 55 crores. This is where you can possibly make a mistake. Will Ind AS become applicable? Yes. Why? Well, because it is a listed company. In your core question, it is a listed company. And if it is a listed company, Ind AS becomes applicable irrespective of whether your net worth is 55 crores or whatever. Okay. However, they are asking, will your answer change if A is unlisted? So this is your first part. If A was listed. In the first part, if A was listed, this is your answer. In the B part, if A was unlisted, then Ind AS is not applicable. Ind AS not applicable in either of the years, in 1617 or in the year 1718. So till that time your net worth does not cross 250 crores, Ind AS will not become applicable. Are we clear with this? Any problems here? Okay. Sir, do I need to read this entire theory which is written? The answer is no. This is a theory which is there in the institute study material. We have mentioned that, but if such a question comes, it is almost certain that such a question will come on the MCQ side rather than a descriptive side. If a question comes on the descriptive side, you will just have to explain the law. So as per the applicability limits, you will have to explain that what are the phases, what are the limits in the given case. Then you mention in the given case, what is the net worth and whether you are listed or unlisted, and then conclude. So every theory answer, you don't have to reproduce institute language. Surely you can look at AIR1, AIR2, AIR3 mark sheets as well. They will, they're certified copies as well. You'll write in your own words, explain the law, connect the law to the given case and conclude. However, it is very likely that if this comes, it will come from an MCQ perspective. Okay, so this is question number 2. Next, we'll go on into question number 3. The net worth of the company B, which is an unlisted company, was 600 crores as on 31st March 2014. However, due to losses incurred in the year 14-15, the net worth of the company went down to 400 crores as on 31st March 15. When will company B, from when will company B apply Ind AS? Let us see if you are able to answer for this. This is question number 3. I will wait for your answers in your chat box. There will be a similar question number 4 as well. So let's say on 31st March 14, then you have 31st March 15. I don't know. 31st March 16 is not available. So over here you have been told net worth is 600 crores. Over here it is 400 crores. So Ind AS applicability will be from which year? Ind AS applicability will be, that is right, it will be from the year 16-17. Sir, why? Because the net worth as on 31st March 2014 is greater than 500 crores, which means later, even if the net worth falls, it does not really matter. You will have to mandatorily apply Ind AS from the year 16-17 onwards. That is right. Okay, so this is from when will company apply Ind AS? Well, 16-17, let us say. Question 3. Then is question number 4. The net worth of company C, which is an unlisted company, was 400 crores on 31st March 14. However, the net worth of the company went to 600 crores on 31st March 15. Again, from when shall company B apply Ind AS? So over here, this was 400. So by default, your application does not start from 16-17. However, later your net worth goes up. It goes up to 600, and unless given otherwise, it continues to remain 600. When will Ind AS become applicable? Okay, even for question number 4, will it become applicable from 16-17 onwards? Yes. Why? Because of the last audited balance sheet concept. So as per the last audited balance sheet, on 31st March 15, your net worth crosses. And hence Ind AS will become applicable from 16-17, even though on 31st March 14, your net worth did not cross that specific limit. By now, is everyone clear with this concept? Yes. So basically, when you are referring the theory, over here, if you face any difficulty, question 1, 2, 3 and 4 are pertaining to this point, which is there in point number 1. So you can just refer them and apply this and get done and dusted. Don't really spend too much time over here, because this is a slightly very outdated concept. It is 10 to 12 years old. Sorry, I have a doubt that if 31st March 14 it exceeds, Ind AS applied, but till 16-17 it will still apply. So in 16-7, if on 31st March 14 the net worth is 600 crores, later the net worth falls, it becomes 200 crores, 150 crores, still Ind AS will mandatorily have to apply because of the specific requirements in this standard. Okay, so this is regarding question 1, 2, 3, 4. Next, you are going to go to question number 5. Let's see. Company D is a parent company of Group A. So at the top sits Company D. Company A is an unlisted company having a net worth of 60 crores as on 31st March 14. Following are the other companies of the group. B, which is an unlisted company, C, which is an unlisted company. They are both subsidiaries of, one is a subsidiary of A, other is a subsidiary of B. Net worth as on 31st March 14 is given to you as 600 crores and then given to you as 150 crores. Whether Ind AS will be applicable to companies A, B and C. Well, we will also look at it for a company D also. So if I look at question number 5, all of these are MCQ type of questions. So let us say at the top there is a company D. Below that there is a company A. I think all of these companies are unlisted, right? So A is an unlisted company, so I'll call this as UL, which is unlisted. And the net worth on 31st March 14 is 60 crores. So on its own account, so if I look at own application or derived application, on its own account, Ind AS does not seem to be applicable. It is unlisted, net worth is less than let's say the specified limit of 500 crores because you're looking at the 31st March 14 balance sheet. Then you look at company B, which is unlisted. But company B seems to have a 600 crore net worth. And hence, for company B, will Ind AS become applicable? You guys tell me. Net worth on 31st March 14. Will Ind AS become applicable? What do you guys think? Yes. Perfect. On its own account, Ind AS will become applicable because the net worth is greater than 500 crores. Sir, we should look at 250 crores. Well, 250 crores will be looked at if you are given the balance sheet on 31st March 20, 25, 26. That is when you look at 250. If you look at the 31st March 14 balance sheet, then 500 is the relevant limit. Perfect. Then there's a company C. C is also unlisted and it has a net worth of 150 crores, which means on its own account, will this be applicable? The answer is no. However, derived applicability, what do you guys think? Will A also have to apply Ind AS? Yes, because it's subsidiary, that is B is under Ind AS. Will C also have to apply Ind AS? Yes, because its parent company A will also, parent company B will also apply Ind AS. In fact, even company D will have a derived application. Will there be any exception in this particular case? The answer is no, because well, there's no fellow subsidiary in this particular case, and hence there will be no exception over here. Now, if I look at an extra possibility, like for example, it is not given over here, but let's say B ke saath there was a company F. Again, this was an unlisted, let's say not over here. Let's say I put it at the top. Let's say there was a company over here, which is F. And we were saying that for company F is also unlisted. It is having a net worth of, let's say, 200 crores. Then would F have to comply with Ind AS? Please answer. Will F have to comply Ind AS? Logic behind question 3. I did not see. You just have to remember that the law mentions. See, this is not what I have mentioned. The law has mentioned that you have to take the net worth as on 31st March 14 or the net worth as per last audited balance sheet date for 16-17 application. So if your net worth has crossed, then you apply as per 16-17. It is a legal thing. It is not something that I have made. So I can't really give you specifically the reason why. I can just explain you from my understanding. So it is the law says 31st March 14 or the last audited balance sheet date, whichever is relevant for the year 16-17 application. So I guess you should move ahead now. Don't get fixated on that same question 1, 2, 3. You just remember this, whichever is the higher of, whichever is of the two gives you higher than 500 crores, then Ind AS will be applicable. Achha, perfect. So over here, this will be not applicable. Why will it not be applicable? Well, because this is a fellow subsidiary exemption. However, this same thing comes, let us say we are doing this extra possibilities. The same thing comes over here for a company F ke baad kya? G. And again, this is an unlisted company. Net worth is, let us say, 150 crores. Will G have to follow Ind AS? Well, yes, because its parent company on its own accord is following Ind AS. The exemption is only for a fellow subsidiary. So when I'm looking at B and its fellow, that is co-subsidiary F, I would say that merely because B is following Ind AS does not mean F has to follow Ind AS. However, for the company G, Ind AS is applicable because its parent company itself on its own account is following Ind AS. So these are extra possibilities which are there. Though for the purpose of this question, what they are asking you is, will Ind AS be applicable to companies A, B and C? Yes, they are not asking you whether it is applicable because of its own limits or because of derived limits. At the end of the day, for A, B and C, and even if it is asked for D, it is applicable. Is everyone clear with this? Yes, okay. So we have given a few extra points. Even D will have to apply Ind AS, assuming it is an Indian company. If there's a fellow subsidiary of company B, say E, with a net worth of let's say 7 crores and having the same parent A, Ind AS would not mandatorily apply to E because A's applicability from B. But if E was a fellow subsidiary of C, that is common parent B, then Ind AS would be applicable to E because B is independently covered under Ind AS, that is not derived. This is exactly the same thing that we discussed over here. Just that there are different names, but it is the exact same thing. So this is question number 5 with extra possibilities as well. Then you go to question number 6. Following is the structure of company D. Okay, so you have the structure thankfully given over here. There's D at the top, then there is E, then there is H. Both of them are subsidiary of D. F, which is a subsidiary of E, and G, which is an associate of E. I, which is an associate of H. Fair enough. All the companies in the above structure are unlisted, and the net worth of company E is 300 crores. So this is having a net worth of 300 crores. You have not been given the date here. And the net worth of all other companies is below 250 crores. Okay, so let us say this is as per your respective year. Let's say net worth on 31st March 2027 or 26. To which company would Ind AS become applicable? Okay, so let us say the limits, you have not been given 31st March 14 data anywhere. So over here, we will look at the limits as if it is for the current year. So let's say, I don't know, the question should have been clear, but let's say this is a net worth on 31st March 26, let us say. And all other companies also have net worth below 250 crores as on 31st March 26, let us say. In which case, my threshold will be 250 crores. Will Ind AS become applicable? In the earlier question, you had a doubt that why D will be there because B ka parent company is A and uska ultimate parent is D. So when I look at the chain, even below C, if there is, let's say, X, there is Y. ये पूरे chain में you will be applicable. It is not, the law does not just say the immediate holding or the immediate subsidiary. It says holding and subsidiary. So even if there's an ultimate holding after 2 or 3 layers, or there's a step down subsidiary, to all of them Ind AS would become applicable. Okay. Okay. Now, if I'm looking at company E, well, will Ind AS be applicable? Yes. To its subsidiary F, it will be applicable. To its associate G also it will be applicable, and to its parent D also it will be applicable. Now the question comes about company H. Will H have to mandatorily follow Ind AS? No. Voluntarily, optionally, if it wants to follow it is its choice, but it does not have to mandatorily follow Ind AS. Why? Because of the fellow subsidiary exemption. Merely because my fellow subsidiary follows Ind AS does not mean I have to follow Ind AS. Fellow subsidiary is like the co-subsidiary. I just mentioned, right, for question 5, why D is applicable. I explained just a couple of minutes back. The law does not tell you applicability is only for immediate holding company. It says holding company, it says subsidiary company, and as a result, all holding companies, D is the parent company of A. So if B is applied under Ind AS, A is also applied, D is also applied. Niche X is also applicable, Y is also applicable. I just explained that. So over here, when we look at when we are looking at these fellow subsidiaries is not applicable, so its associated subsidiary is also not applicable. So to which company would it apply? Well, it will apply to E primarily, and through that it will apply to its subsidiary, that is F, to its associate, that is G, to its parent, that is D. These companies have to mandatorily follow Ind AS. However, other companies like F and like H and I need not follow Ind AS. Are we clear with this? Yes. Okay, so this kind of takes care of question number 6. Next, you will go to question number 7. ABC Inc. is incorporated in a foreign country has a net worth of around 700 crores. Okay, it's a foreign company and net worth of 700 crores. It has two subsidiaries, X whose net worth is 600 crores and Y whose net worth is 150 crores. So if I look at the corporate structure in question number 7, there's a company ABC Inc. which is incorporated in a foreign country. So it does not necessarily have to do Indian reporting. Now its net worth is 700 crores. And it has two subsidiaries as what is mentioned. If you go to see X whose net worth is 600 crores, Y whose net worth is 150 crores. This is as on 31st March 14. There is X, there is Y. This is as on, this is your net worth of I think 600 crores and net worth of 150 crores. This is on 31st March 2014. Okay. Whether company X and Y would be required to follow Ind AS from the accounting periods commencing on or after 1st April 16 on the basis of their own net worth or on the basis of the net worth of ABC Inc. Acha, first of all, will X have to follow Ind AS? Yes. So Ind AS applicable. Is it because of its own applicability or derived applicability? Sir, own applicability. The net worth is greater than 500 crores. Net worth on 31st March 14 is 600 crores, that is greater than 500, and as a result, it will have to follow Ind AS. Now, if X has to follow Ind AS, technically ABC Inc. also has to follow Ind AS. Acha, but my point is, even if ABC Inc. के नीचे X subsidiary was not there, its net worth is 700 crores. What do you guys think? Will ABC have to follow Ind AS? Will ABC have to follow Ind AS? No. Why no? Because it is a foreign company. So unless it is required to do reporting in India, it need not have to follow Ind AS. But net worth is 700 crores. Well, there will be thousands and lakhs of companies across the planet. Let's say in South Korea, in Brazil, in Argentina, who might have net worth of more than 250 or 500 crores as the case may be. Do they also have to prepare their accounts in India? The answer is no, because they are foreign companies. Unless they are required to do reporting in India, they don't have to follow Ind AS. So over here, we can say Ind AS not applicable. Why? Well, it is a foreign company. Here, the way institute tempts you is it will give you two carrots. It will say, देखो बेटा, net worth is 700 crores. Tell us that Ind AS is followed. We'll say, no, it's a foreign company. Okay, X is its subsidiary, it has Ind AS, so ABC will also apply Ind AS. We'll still say, no, it's a foreign company. Unless it is required to do reporting in India and unless it is given otherwise, foreign companies don't have to do reporting in India. Then there's no need for that company to follow Ind AS. Remember, only if they have to report in India will they need to follow Ind AS. Are we clear with this? In such a case, ABC will not be needed to comply with Ind AS. Now, what about Y? Will Y have to follow as per Ind AS? Not applicable. Why? Because its parent company, that is ABC, is not following Ind AS. Maybe its fellow subsidiary is, but fellow subsidiary exemption is available, and as a result, Y need not follow with Ind AS. However, if ABC were to report in India, or let us say ABC was an Indian company, it was not a foreign company, then let's see if you are able to answer. Let's say ABC is an Indian company or it has to report in India. Then what is your answer? Then will ABC have to follow Ind AS? Yes. Why? Because ABC's net worth is more than 700 crores. Well, one of the reasons may also be that it has a subsidiary, but even if it did not have a subsidiary, the fact that its own net worth is 700 crores, that is more than 500 crores, ABC will have to follow Ind AS. Now give me the answer for company Y. In such a case, will company Y? That's correct. Even company Y will have to follow. But I will take the fellow subsidiary exemption. Y will have to follow Ind AS because its parent ABC, let's say, which is in our extra case an Indian company, is following Ind AS. Are we absolutely clear with these possibilities? It's more if you go to see an MCQ type of a test where you have multiple choices for multiple companies rather than a descriptive. Till date, none of these questions have made it to the descriptive side, and hence from an exam perspective, have a general understanding and proceed further. It is unlikely to come other than an MCQ over here. So if you see what is asked, whether company X and Y would be required to follow Ind AS. X will have to follow Ind AS. Y will not have to follow Ind AS. So X will have to follow because of its own net worth, not because of its parent net worth, its own net worth, and Y will claim the fellow subsidiary exemption. So X will have to follow. I mean, you can write this summary point if you want. So when you are revising, you can just refer to this summary solution. If ABC is reporting in India, it is the same conclusion as we just gave. Then ABC will also have to follow Ind AS. Company Y will also have to follow Ind AS. Okay. Then you have question number 8. As per roadmap, Ind AS is applicable to company X from the financial year 17-18. Company X, okay, as per the roadmap, Ind AS is applicable to company X from the year 17-18. Okay, they've told you this. Company X, which is a non-finance company, is a subsidiary of company Y, which is an NBFC. Okay, so this is interesting. So you'll have question number 8 where you have Y, which is an NBFC, and X, which is a non-finance company. Remember, the roadmaps are completely different. Here, that holding subsidiary thing does not apply. Like even when we looked at that insurance company, we said that merely because parent company is following Ind AS does not mean insurance company will follow, because they have separate roadmaps. So if I look at question number 8, there's a company Y, which is an NBFC. And then there is a company X. This is a regular non-finance company. So it's not a bank, not an NBFC, not a mutual fund, not an insurance company. As per the roadmap, Ind AS is applicable to company X from the year 17-18. Company X, which is a non-finance company, is a subsidiary of Y, which is an NBFC. Y is an unlisted NBFC having a net worth of 400 crores. What will be the date of applicability of Ind AS for company X and company Y? If Ind AS applicability date for the parent NBFC is different from the applicability of a corporate subsidiary, then how will consolidated finance statements of the parent NBFC be prepared? Again, what is happening? You have been told that the transition date for company X is the year 17-18. This is given. So if you see the first line, this as per the roadmap, Ind AS is applicable to company X from the financial year 17-18 onwards. So in the year 17-18, we are saying company X will follow Ind AS. Think and tell me, merely because company X follows Ind AS, does its parent company Y, which is an NBFC, they have told you the net worth is 400 crores. They have not given you the net worth on which date, and hence they will assume that in each of the dates, the net worth remains constant, because if it is not constant, they have to tell you okay, by every year what is the net worth. So over here, net worth is 400 crores. Now you guys tell me, for an NBFC for the year 16-17, I don't know, for the year 16-17, will this NBFC have to follow Ind AS? No. In fact, even company X in the year 16-17 will not have to follow Ind AS. However, 17-18, they say it is applicable, this is given. Think and tell me, in the year 17-18, will the NBFC Y have to follow Ind AS? Please answer. You are saying no. Why no? My subsidiary is following Ind AS, so ideally I should also follow Ind AS. However, there will be a separate roadmap. So in NBFCs, the roadmap is separate merely because its subsidiary, which is not a NBFC, is following Ind AS, does not mean the NBFC has to follow Ind AS. Are we clear with this? Okay, so 17, 18, they will not follow. Let us say 18, 19. Now this is interesting. 18, 19, 19, 20. What about company X? Well, company X will continue to follow Ind AS because once it follows Ind AS in one of the years, it will have to follow Ind AS in each and every subsequent year. However, about the NBFC, in the year 1819, remember it's a +2 roadmap, which means in the year 1819, if the net worth is more than 500 crores, you will have to follow Ind AS. Well, net worth is 400 crores. So will I follow Ind AS? No. Still no. In the year 1920, think and tell me. Now will the NBFC follow Ind AS? Yes. Why? In the year 1920, we will have to follow Ind AS because now the net worth is greater than 250 crores. See, till now the net worth was 400 crores. Well, it was less than 500 crores. But from this particular date, your net worth, which is 400 crores, which is greater than 250 crores, NBFC will follow Ind AS. Okay, now when I look at the CFS, in the year 16, 17, 17, 18, 18, 19 and 19, 20. So when I look at the year 16, 17, both of them were not following Ind AS, which means there will be AS only. There is no restatement needed. In the year 17, 18, Y, which is a parent, is following AS. However, X, which is a subsidiary, is following Ind AS. So your overall CFS will be based on the parent's policy, and the parent's policy is AS. You will have to restate X as per AS for consolidation. It is only for CFS, that is consolidated financial statements, will you have to restate. Similarly, when I go to 18, 19, well, again, when I look at 18, 19, Y is not following, X is following Ind AS. So in my CFS, I will still have to prepare as per the parent's policy, which is AS, and I'll still have to restate X as per accounting standards to maintain consistency. But when I go to the year 1920, Ind AS is followed by Y, Ind AS is also followed by X, and hence your consolidation will be done as per Ind AS only. Again, there will be no restatement needed. Is everyone clear with this? It's a highly complex problem. If you have any doubts, please do mention. No? Okay. So over here, this is question number 8. They are mentioning what will be the date of applicability for Ind AS for company X and Y. So in the first part, you will say X will follow Ind AS from the year 1718. Well, why? Because this is given. Whereas Y will follow from the year 1920. That is when its net worth limit gets crossed. There is the first part. This is point number 1. This is solution to point number 1. If Ind AS applicability date for the parent is different from the applicability of the subsidiary, as can be seen over here, there's a difference of around 2 years, then how will the CFS of parent NBFC will be prepared? So over here, CFS will be based on parent, that is Y's policy, that is accounting standards, and you will restate X for the purpose of consolidation. Are we clear with this? Yes. Okay. So this is question number 8. And the last question is, it's an exam question, but it is a theory question per se. So there is nothing new over here. This is based on the roadmap application. So question 9 says, list out the entities which are covered in phase 1 and 2 under the company's Ind AS rules of 2015 as notified by the MCA, along with the specific date of coverage with its exclusions, if any. So over here, you can just say that you can refer page 1 of our shield. So they have given you a fairly detailed solution, but that is in a slightly more technical language. If you write in your own words as well, this part is what is required along with exclusions. So exclusions for banks, NBFCs, insurance companies, as well as companies listed on the SME stock exchange. That is what we have to mention about. It's a pure theory question. Is everyone clear with this? So as they say, exclusions, the roadmap will not be applicable to securities who are listed or in the process of listing on the SME platform. Also, Ind AS will not be applicable to companies other than listed companies whose net worth is less than 250 crores, and they will continue to follow AS. But they can voluntarily adopt Ind AS. This is for regular companies. For banks, insurance companies, NBFCs, you cannot voluntarily follow Ind AS. So that kind of takes care of the applicability section. Any problems or queries here? No? Acha, in question 6, the reason for non-applicability of Ind AS to company H is D applicability is derived, not own. That is correct. D's applicability is derived applicability, not its own applicability. If D is net worth itself was greater than, let's say, the specified limits, then H will have to follow Ind AS. Okay, perfect. So we can go into the next topic, Ind AS 16. Do you want a small breather now, or maybe after another 15-20 minutes? Can we start with Ind AS 16 now, or you want a small breather? Okay, so we'll probably do around 15-20 minutes and then stop for a small breather. So then we can continue. So this is, we'll go into, is this applicability part of Ind AS 1? It is given by the institute along with Ind AS 1, though it is not mentioned inside Ind AS 1. So it is a separate notification by the MCA, Ministry of Company Affairs, on its own. Okay, so when we go to property, plant and equipment, this is a tier 1 category chapter. It is a category chapter. From an exam perspective, it is important, and it forms the basis of even understanding other chapters like Ind AS 40 investment property, Ind AS 38 intangible. So this is like the, I would say these three standards, Ind AS 16 PP, Ind AS 40 investment property, and Ind AS 38 intangible assets, are to be studied in continuation, for which if you know Ind AS 16 properly, the other topics will be fairly more easier. Okay, so have you done a specific standard like this earlier? Yes, there was accounting standard 10 or AS 10, and this standard is largely on similar lines for property, plant and equipment, and we will kind of review the important principles over here. When you look at the standard, there are 4 main headings over here of what do you need to study. First of all, we look at what value should you record the asset initially, special cases in that. Then any subsequent expenditure after the asset has been initially recognized, how do you treat that? That is the second point. Third, what if how at every balance sheet date, how do you measure it? And lastly, how do you measure depreciation? So 4 things: initial recognition, which is at cost; subsequent expenditure, when to capitalize, typically when it increases life or efficiency beyond what is originally assessed; third, subsequent evaluation in the balance sheet. It can be either using the cost model, that is cost less depreciation, or using the revaluation model where you revalue at fair value; and fourthly, depreciation using the methods like SLM, WDV, etc. So that's it. Khatam ho gaya AS10. Let us go into the next topic. No sir, there's a lot of nuances that we need to study over here. First of all, before we go into that, we need to understand what is a PP, what is a property, plant and equipment. Well, a PP meets 3 criteria. First, it has to be tangible. Property, plant and equipment, it has to be tangible. I can touch, feel, see. That is, it has to have physical substance. Point number 1. Point number two, it has to be held for use. Like someone might say that what is an example of a PP? Sir, plant, machinery, cars. These are general things. If I am a company like Toyota, for me, cars are not PP, they're inventory. Why? Because they're held for sale in the ordinary course of business. So for something to be PP, it has to be held for use. And use is a very wide term. It's a very open-ended term. It has to be held for use. And lastly, point number three, the life of that has to be more than 12 months. Like you have raw materials, consumables, they are also held for use. Raw material is not held for sale. Consumables, nut, bolt, screws are not held for sale. However, they are typically going to be consumed in less than 12 months. And as a result, we would say that, well, these are consumables. They will be shown along with inventory, like raw materials or consumables are shown along with inventory. However, if there is an item which is held for use other than these items, then that will go under PP. So for something to go under PP, it has to tick box. It has to kind of meet three criteria. First, it has to be tangible. That is, you can touch, feel, see. It has to have physical substance. Second, it has to be held for use. Use is an important word which we will elaborate on. And third, the life should be more than 12 months. If all the three criteria are met, then we can say that this is a PP. Now, among these criteria, use is an important word. Now, when you look at use, a lot of times people misread it. They say that, okay, there may be machinery which is used in the factory, which is used for the purpose of manufacturing our products. Is that PP? The answer is yes. However, that is, you are saying that that helps me in making products. It is, let us say, held for my production. But that is not always the case. Like for example, if you go to big offices, around the reception area, you see big paintings. So modern art wale paintings are there, which are modern art. You don't understand anything, but a lot of companies put that. Is that painting held for sale? No. Is that painting going to increase revenue of the company? Not necessarily. Use does not mean it has to increase the revenue. Student believes that use means it has to increase the revenue. No, that use means use. It can be used for production use like a machinery. It can be used for administrative use like an office painting. It can be any kind of use. It can also be for the purpose of, let's say, pollution control equipment. So if there is certain equipment which you have installed in order to reduce pollution, you are a very environmentally conscious person. So in order to reduce pollution, you have put in some equipment that is also considered to be, for example, use. Use can be any kind of use. It can be administrative. It can be selling and distribution like delivery vans. It can be production. It can also be employee welfare. Like for example, if you have seen videos about like offices in Google and Meta, etc., very, very fun offices. You have bean bags, you have PlayStation, Xbox, etc. We like seeing these videos, and then life gives you back the reality. You go back to your article ship where you are sitting in a corner without an air conditioner. So that ways, use can also be employee welfare. Like for example, if there are a PlayStation or an Xbox in your office for employee welfare, well, that is also held for the purpose of use, not for the purpose of sale, in which case that Xbox, which is tangible, which has a life of more than 12 months and it is held for employee welfare, that is also considered to be a part of PP. So you don't have to bring that correlation between revenue and the asset. The law says it has to be held for use. Use can be administrative, it can be selling and distribution, it can be production, it can be employee welfare, it can be finance, accounting. It has to be held for use. Are we clear with this? Yes, okay. So this is what is use. Spare parts of machinery, if their life is more than 12 months, then it can be taken as a part of PP. If the life is less than 12 months, it will be taken as a part of inventories, consumables, loose tools, for example. So definition of PP, it has to be tangible, held for use, can be production, selling, distribution, admin use, and having a life of more than 12 months. So first of all, we need to understand what is meant by a PP. Second, I mean, again, from an exam perspective, we will not review it, but from a practical standpoint, there's a concept of materiality. But this is again practically. Exam, you don't have to see this. Like for example, this calculator that you have. Now this calculator, is it tangible? Yes. Is it held for use? Well, kind of yes. And does it have a life of more than 12 months? Again, yes. So ideally your CA firm who owns this calculator and probably which you are using should show it as a PP. However, it's a very small amount. It's hardly a few hundred rupees. So maybe from a practical standpoint, it may not be as material, and in such a case, you can write off as office expense. But from a student standpoint, unless the question tells you that the expenditure is not material, it is always considered to be material. Okay. Further, there may be certain items which meet the definition of PP. Listen to this carefully, which meet the definition of PP. However, they are scope exclusions. Why? Because there's a separate standard. Like, for example, there is something called as non-current assets held for sale. Like, I might buy an asset, like let's say a classroom, a bench, etc. That is PP for me. I'm holding it for use, but sooner or later, some or the other day, I will intend to sell it, dispose it. So now the primary intention is no longer use, the primary intention is sale, and hence you should no longer show it as PP. So what should we do? Should we show it as inventory? The answer is no. Why? Because inventory is held for sale in the ordinary course of business. If you have a plot of land or a furniture item or a building which you intend to sell, it does not automatically become your inventory because it is not held for sale in the ordinary course of business. So it is not PP because it is no longer held for use. It is not even inventory because it is not held for sale in the ordinary course of business. Then where does this item go? Well, there's a separate standard called as Ind AS 105, which is non-current assets held for sale. So if there is a asset which you intend to sell in the foreseeable future and certain conditions are met, then you can show it as Ind AS 105. Then Ind AS 16 will not apply. So scope of Ind AS 16 excludes non-current assets which are held for sale because they will be covered under Ind AS 105, a separate standard. Secondly, there's a separate standard called as exploratory and evaluatory assets linked to mineral operations. Again, this is not restatement means, sir. I mean, in what context are you asking? I do not get the question. So, restate means you will reclassify if you're asking that from PP to non-current asset held for sale, you will reclassify it. Exploratory and evaluation assets linked to mineral operations. There's a separate standard Ind AS 106 for this. It is not there in your syllabus because it is highly technical and linked to mining activities. So what does it mean? Like, for example, when you are a mining company like an ONGC or a British Petroleum, I mean, you would have seen that they dig oil wells. However, how to identify the spot where to dig the well? A lot of expense is done, a lot of seismic studies, topography studies are done to evaluate where to dig that oil well. So what do I do with the expenditures behind this? Well, like in an intangible, there's a research expense, there's a development expense. For a mining company, a lot of money is spent to evaluate and decide from where to explore. So what do I do with that expenditure? Well, should I capitalize it along with the cost of the mine? Should I expense it to P&L account? For this, the standard has stipulated separate guidance under Ind AS 106, which is beyond the scope of your curriculum because of its highly technical nature. Institute has not put this as a part of your course, but you need to know for the time being that any exploratory and evaluatory expense, only the specific expense linked to mining operations, will be out of Ind AS 16. You will not consider this for the purpose of Ind AS 16. And next you'll have biological assets. Now this is the only thing which I would say is relatively important because there's a separate standard. Biological assets are living assets like livestock. You have someone like Amul. Amul might have a lot of cows. Now these dairy cows are biological assets. They have life. Okay, the cow is tangible. It has a life of more than 12 months and it is held for use. That is, it is held for the purpose of the milk that it gives. And hence the cow meets the definition of PP. And if it meets the definition of PP, it should ideally be covered under Ind AS 16. Perfect. So there's no problem in that. However, there's a scope exclusion. Why? Because these biological assets, like this is a living animal, they have certain unique properties. Like, for example, a biological assets may reproduce. So if I apply Ind AS 16 principles, Ind AS 16 or AS 10 will tell you that PP has to be initially shown at cost. Now, if a cow reproduces and a calf is born, in that you have no role. Whatever had to be done has been done by the cow, the bull, whoever, and let's say the calf is born. Initial recognition will be at cost. Cost is 0 rupees. And hence, in a matter of years, your entire livestock will come down to a zero balance. Why? Because of the special nature of a biological asset, which kind of reproductive in nature. If you follow core Ind AS 16 principles, it might result in after a few years, your existing cows that you might have purchased will die. Your entire new herd of cows that will be there will be from the reproduction that was done by the existing cows, but that will be shown at zero cost, and hence that will distort reporting. So they say, let us remove these biological assets out of Ind AS 16, and for that let us give a separate guidance. Like there will be a separate standard you will study called as Ind AS 41, which is exclusively dedicated for biological assets used for agricultural activities, where we'll study what is a biological asset, we'll study what is agricultural activity, we'll study all of these. So biological assets means assets where there is a life will be removed out of the scope of Ind AS 16 and will be put into a separate standard like Ind AS 41, for example. So scope exclusion will be biological assets for agricultural operations. Great. But there is a catch over here, which was even there in your inters here. There is something called as bearer plants. Have you heard about bearer plants? Okay, bearer plants are plants which bear agricultural produce, and they are not agricultural produce themselves. No, sir, again. A bearer plant is a plant, it's a living plant which bears agricultural produce, but it's not agricultural produce itself. For example, when you look at a coconut tree, that tree bears coconut, and the tree itself is not the produce. Or a mango tree, it bears the mango and it itself is not the produce. So these are bearer. Or an apple tree, they are all bearer plants. Sir, every plant is a bearer plant only? No, not necessary. Like you look at a bamboo tree, for example, or a sugarcane plantation itself. So when you look at a bamboo tree, the bamboo that is a tree itself is the produce. It is not grown for the fruit or the vegetable or whatever it bears. The tree itself is the produce. So when I look at a bearer plant is a plant which bears agricultural produce and is not produced itself. A bearer plant is covered under Ind AS 16. Other than bearer plant, if there are other plants like a bamboo tree, for example, that is covered under Ind AS 41. So the standard will study the logic and everything in Ind AS 41. However, from a legal perspective, we will say that what is covered under Ind AS 16? Well, biological assets, that is living assets, if they are bearer plants, then they'll be covered under Ind AS 16. And bearer plants have two important features. First, they should bear produce and should not be produced themselves. Second, they have to have a life of more than 12 months. That is, they are not an annual crop. Like for example, if you look at a wheat grain plantation, it is technically a bearer plant because it bears the grain and it itself is not the produce. However, if you have seen how farms operate, you might have traveled by trains and sometimes you see the farms are lush green, but sometimes the farmer would have removed all the crop. So after the grains are grown, the farmer will remove all the crop and then they will plant another, like we have the Kharif season in India, the Rabi season in India. So these crops may be bearing, let us say, the grains. However, if their life is not more than 12 months, then they cannot go into the Ind AS 16 criteria. Ind AS 16 requires three things. It has to be tangible, held for use, and a life of more than 12 months. So a bearer plant should bear produce, but it should also have a life of more than 12 months, because if it is a bearer plant, it will go under Ind AS 16, and for it to go under Ind AS 16, it should have a life of more than 12 months. So something like a coconut tree, an apple tree, a mango tree will have a life of more than 12 months. It will bear produce and hence they will become bearer plants. Even if you look at Tata tea, for example, if you have ever been to places like Munnar or all of these places where there are tea gardens, you will see that what happens over there is there are these tree plantations. People come, they will remove the tea leaves, they will trim the tree to a particular waist height or something where it is easier to pluck the leaves. So these tea gardens, the trees that were planted have a life of more than 12 months. We are collecting the produce, let's say the tea leaves or the coffee beans, for example, and the life is more than 12 months. So they're bearing produce, life is more than 12 months, in which case it is a bearer plant. Sir, we'll have to study zoology and biology for all of this. Well, not needed. In general, from an exam perspective, they will usually tell you whether a plant is a bearer plant or not. But if they don't tell you, remember, Fruit plantations generally are treated to be bearer plants, and cash crops like cotton, rubber, tea, coffee are treated to be bearer plants. That is a general thing which the institute is doing. However, they can give you some weird item as well. Like in one of the RTBs, they gave a tree called as Pinus radiata tree. Now, even if you ask a zoologist in India, they will not know about this tree. It's an Australian tree. How will we know about it? So they will explain. So they told in the question that an entity had 100 Pinus radiata trees, which had a life of 30 years and will ultimately be used for the purpose of building material and furniture. There is no other use of that tree. In which case, you are holding that tree for, I mean, it's not bearing any produce. That the tree itself is the produce. It will mature like a teak wood plantation, timber plantation. The tree itself is the produce. So long story short, if it's a bearer plant, it will be covered under Ind AS 16. Other than a bearer plant like a bamboo tree, sugarcane tree, etc., this will be going under Ind AS 41. All types of living animals which are used for agricultural activity will also go under Ind AS 41. For the timing, I think that should be sufficient. Once you do Ind AS 41, you'll get better clarity on this. What is an agricultural activity? What is bearer other than bearer, etc. But are we broadly clear with this? What about horses? Race horses. Let us say if you're holding race horses, it gets a little technical over here. Race horses do you think they're used for agricultural activities? No. Race horses are not used for agricultural activity. What is agricultural activity? Again, it is defined under Ind AS 41, which is for agriculture only. But race horses for sure are not agricultural activity. And as a result, well, it is not covered by Ind AS 41. Then it might be covered under Ind AS 16. Right? But there are sums on this, proper sums on this, like a security dog or a race horse, for example. How do you deal with this? So for the time being, we look at biological assets for agricultural operations, except for bearer plants. Well, when I look at a summary, biological assets for agriculture, like living assets, if there are living plants, and if they are bearer plants, then they will go under Ind AS 16. If they are other than bearer plants, they will go under Ind AS 41. But if there are living animals, then if they're used for agricultural perspective, all living animals for agriculture will be covered under Ind AS 41. Are we clear with this? Okay. So what is a bearer plant? A bearer plant is a living plant which bears agricultural produce like a coconut tree, and is not agricultural produce itself like a bamboo tree. That is a bearer plant. However, it has to have a life of more than 12 months. They are expected to bear produce for more than 12 months, like a wheat grain plantation will bear wheat for less than 12 months. And then it will be chopped off. Hence, it is not a bearer plant. So when I look at a bearer plant, it has to bear agricultural produce and it has to have a life of more than 12 months. If both of these core criteria are met, I would say it's a bearer plant. We have put that as a reference point unless given otherwise over here before we read point C. Fruit trees, tea, coffee, rubber, even cotton to that extent are treated as bearer plants. From an exam perspective, that is sufficient. Otherwise, they will tell you. Now, the third point, that is point C, is more of a clarification point. They say that someone can always argue that even if there's a coconut tree or even if there's a mango tree, ultimately that tree will be cut and I will use their wood. However, do you think when I grow the mango tree, the primary objective is the wood that I get or the mangoes that it will bear? The mangoes that it will bear. And hence, getting the wood is like salvage value. It is incidental. Even every PP you will ultimately sell. You will get a salvage value, but that does not mean PP has to be shown as a held for sale asset. It will ultimately be sold, but till that time it is a PP. So ultimately you can even chop the tree down. However, the proceeds that you get from that is considered to be incidental in nature. It is not its primary objective. So they say there's a remote likelihood that the plant itself will be sold as agricultural produce, except for incidental scrap sales. Like a mango tree held for mangoes. However, ultimately the tree may need to be cut down. Classification will be based on the primary intention. Primary intention is for the mangoes it bears, not ultimately that will be chopped down. And hence it is a bearer plant. So basically, till now, if you look at PP, if I were to summarize before I go to the next section, is what is a PP? It is tangible, that is having physical substance, held for use, and life of more than 12 months. There are three items which are not covered under PP. One is non-current assets held for sale because it's covered under Ind AS 105. Exploratory and evaluatory expense linked to mining operations because it is covered under Ind AS 106. And biological assets used for agricultural activities because it is covered under Ind AS 41. However, for biological assets, if there's a bearer plant, as it bears produce, having a life of more than 12 months, then it will be covered under Ind AS 16. Every other plant other than a bearer plant will go under Ind AS 41. Living animals, as long as they're used for agricultural purposes, will also be covered under Ind AS 41. Are we clear with this? Yes? Okay. So before we go ahead into the section of initial recognition, general cases, we'll stop for a small 5-minute breather. Take a quick breather, be back in 5 minutes by around 2:50, and we'll then go on into the initial recognition section. Okay. Any problems here? Any doubts till now? Hello, hello, hello. Can you please confirm if the audio and video is clear? Hello, hello, hello. Okay, so let's proceed on into the last session of the day, and this is generally the point of the day where you are tired. We'll just hold on for some time and we'll get done. So now we deep dive into the main standard. Okay, so when I look at the main standard, as I said, there are 4 things that you are going to study. First is initial recognition. At what value will you initially recognize a PP? That is typically at cost, but what all goes into cost? Secondly, subsequent expenditure. Third is subsequent valuation. Fourth is your depreciation. So first is initial recognition. At what value will you initially recognize a PP? Well, I will initially recognize a PP at cost, but what all goes into cost? If I were to purchase a PP, let's say I'm importing a machinery from Germany, will the purchase price of the machinery be a part of my cost? Well, obviously yes. However, what if the supplier gives me some discounts? Now, discounts can be of 2 types. One, there can be a trade discount. One, there can be a cash discount. A cash discount is linked to early payment. A trade discount is every discount other than a cash discount. Like for example, if you can negotiate hard or you're buying in bulk, you get some discount. That is called as a trade discount. So if you're buying a product, let us say for 100, however, you get a 10 rupee discount, which means if it is a trade discount, you are effectively paying for the product. 100 minus 10, that is equal to 90. So what does accounting principles tell you? Well, I will take the purchase price minus the trade discount. Cash discount, if any, will show separately in the P&L because that is linked to early payment. It is not linked to purchase of the asset. It is because you're making the payment early. That is why you show it. So generally accepted accounting practices tell you that cash discount should be taken in the P&L, whereas trade discount will be deducted. So over here, when you look at the purchased asset, in the purchased asset, you'll have the purchase price, let us say 100. From this, you will subtract trade discount. Let us say this is 10. Now, other than that, there can be certain taxes, like for example, there can be import duty. Now, typically for import duty, you don't get any credit. However, if there is some GST, GST can be creditable. So, if for example, there is a product of 100 on which there is a 18 rupee duty, where you are not going to get credit. Like for a student, when you pay for any products or services, well, you don't, most of you, I believe, don't have a GST number, and as a result, well, you cannot claim any GST credit. So for you, for all practical purposes, it may be 100 plus 18, that is 118, but for you, for all practical purposes, it is 118. The product costs you 118. However, if you have a GST number and if the credit can be claimed and it is eligible, then you can say that, okay, I'm paying 118 now, but out of that 118, 18 can be claimed as a credit, and hence effectively for the asset, I will be paying 100 only, because that 18 that I'm paying, I can claim as a credit. So I will add what I call as a non-refundable or non-creditable taxes. Like an import duty is typically non-refundable, non-creditable. When you buy a property, you pay stamp duty. Stamp duty is non-creditable, non-refundable. You will add it to the cost of the PP. But when you look at something like a GST, depending on the GST laws, you're not studying an IDD paper, you're doing an FR paper. So you can assume that GST is creditable. However, import duty, customs duty, stamp duty, or local taxes and cess can be assumed to be non-creditable. So what we will add into our cost is non-creditable taxes. So for example, there is a duty, like for example, when you import cars, if you have let us say a flair for cars, if you end up importing cars, these imported cars have, I mean, before this deal that was done with Europe and US, you would end up paying 100 to 150% duty. So for a 100 rupee car, you will end up paying close to 150 additional for customs duty. And as a result, the car cost for you is much more higher. So when I look at non-creditable taxes, let's say there is a 20 rupee tax, I will add that, provided it is non-creditable, because if it is creditable, well, it's not a cost for me. I can claim credit. Are we clear with this? Yes? Okay. Next, you have, let us say, something called as directly attributable expenses. What do you mean by directly attributable expenses? These are expenses that you are incurring to bring the asset in the location and condition as desired by the management. That is, expenses incurred to bring the asset in the ready to use condition. Like for example, when I'm importing products, I will have to pay for the freight to get the products from Germany to India. I will probably have to incur certain insurance, loading and unloading charges. All of these are called as directly attributable expenses to get the asset in the ready to use condition. Or in a simplified manner, if I were to buy an air conditioner, that air conditioner, just a second. If I were to buy an air conditioner and that air conditioner needs to be installed. So the air conditioner cost me 20,000. However, I'll have to call someone to install it. He will charge me another 2,000 rupees. That 2,000 is directly attributable to bringing the air conditioner in the ready to use condition, and hence that 2,000 will be capitalized. So when I look at the cost of the AC, it will definitely include the purchase price, the non-creditable taxes, but it will also include the directly attributable expenses like installation charges, etc., like freight inward, etc. So directly attributable expenses are those expenses which are incurred to get the asset in the ready to use condition, that is in the location and condition as desired by the management. Okay, so I will have, let's say there is another 30 rupees of freight inward, and that will give me my total cost. Now there are a few other items as well which we will discuss, but for the time being, this is enough for a purchased asset. Now if there is, let us say, a manufactured asset, then instead of purchase price, you are going to self-construct an asset, in which case you will incur material cost, you will incur labor cost, you will incur overheads. Overheads are of three types, if you remember: production overhead, selling and distribution, and administration. In the cost of the PP, you will only take production overheads. It can be fixed, it can be variable, but that is to be taken. Administrative and selling and distribution overheads will go to the profit and loss account. They cannot be added to the cost of the PP. Like if you do major marketing, you are building a building, and you do a lot of advertising, that does not increase the cost of the building, and that selling and distribution expense will go to the P&L account. However, you employ labor, or let us say you use equipment for the purpose of construction of that building, all of that will be taken as a part of the cost of the building. So over here you will include material, labor, production overheads. It can be fixed production overheads like rent of equipment used for the purpose of building construction, or even variable production overheads. They will be a part of your cost. If you have taken a loan and you are paying interest, will the borrowing cost be capitalized? We'll study that in a separate standard. However, in your CA Inter, there was an AS 16, and AS 16 used to say that if what you are constructing is, let us say, a qualifying asset. Qualifying asset is an asset which takes a substantial period of time, let's say more than 12 months. If it is a qualifying asset, then the cost that you are incurring, that interest cost will be capitalized. Otherwise, interest cost goes to the P&L. Do you broadly remember this? Okay, so borrowing cost will be capitalized if it is a qualifying asset. If you're constructing or purchasing an asset which takes a substantial period of time to be ready for its intended use, then the borrowing cost during the period it is being constructed will be capitalized. Now, before we proceed further, there is something called as present value of site restoration or decommissioning expenses. Probably we will discuss that in tomorrow's class. However, before that, we want to understand this slightly better, what we have done. So, there are a couple of points that I want to clarify. First of all, when I look at production overheads, let us say I'm spending power, electricity, while constructing my building. Let's say I'm constructing an office building, and while constructing the office building, I'm having materials, there is some labor, but they're using some equipment which needs, let's say, electricity. So power is getting consumed. What do you guys think? Will that power cost be capitalized? Will that power cost be capitalized? Well, the answer is yes. The power cost will be capitalized because hello. Yes, it will be capitalized because it is a variable production overhead. However, let us say there's a fixed production overhead. Like for example, if you see a building being constructed, there may be certain cranes that are used for the purpose of construction of the building. You don't have those cranes, so you take the crane on rent, which is used for the purpose of building construction, and you pay certain rent amount for the purpose of this crane. Will that is fixed amount. Now whether the crane is used or not used, you have to pay that amount. So what do you guys think? Will the rent paid for the crane, which is directly attributable to the construction of the building, will that be capitalized? Fixed production overheads, will that be capitalized? Yes, it will be capitalized. Okay, so this is generally understandable. However, what if, listen to this very carefully, you might make a mistake over here. What if you don't take the crane on rent, but you have your own crane and you use that crane? On that crane, let's say it's a 1,000 rupee crane, it has a life of 10 years. During the year, there's a 100 rupee depreciation. Depreciation is non-cash in nature. Your journal entry is depreciation account debit 100 rupees to crane 100 rupees. Your crane of 1,000 minus 100 becomes 900 because it has been used. Usually depreciation goes to the P&L account. But in this case, can you capitalize the depreciation of the crane which was used throughout the year for the purpose of building construction along with the cost of the building? Think and tell me. Can the cost of the building, definitely will include the material cost, labor cost, power cost, rent? If I'm paying for the crane, I will include it. But if I own the crane, then I don't pay any rent. However, there's some depreciation that is there on the crane. Will that also be a part of the cost of the building? Think and tell me. Okay. See, the thing is, you are generally thinking that how can depreciation be a part of cost? Remember, depreciation, you are doing books of accounts. You're not doing financial management or decision making. In books of accounts, cost can be cash cost can be non-cash cost. When you calculate the cost, the law does not tell you only the cash expenses which are necessary to bring the asset in the ready to use condition. No, expenses which are necessary to bring the asset. These expenses can be cash expenses, it can be non-cash expenses as well. And hence, if there's a depreciation on the crane which is used for the purpose of constructing a building, that depreciation will also be capitalized along with the building. So your entry would be depreciation account debit, let's say, to crane, and then instead of P&L account debit to depreciation, you will say building account debit to depreciation. If you go back to your CA foundation and you remember the manufacturing and trading and P&L account, in the manufacturing account, sometimes you also see the depreciation. So depreciation can very well be a part of your cost, but remember, this is not depreciation on the building. This is depreciation on the crane which is used for the purpose of constructing the building. It can definitely be a part of the cost of the asset. So when I include the production cost, remember, this can be cash or even non-cash. So I can have cash and even non-cash to be a part of my overall cost. Uh, it is an outcome of recording the asset correctly. You want to show the asset at its true cost. There may be two companies who are making buildings. If one of them is taking cranes on rent, another of them is using their own cranes, it does not mean that only the guy who takes it on rent is incurring a cost. Person who has the crane, who is using the crane, is also incurring a cost, just that that cost is in the form of depreciation. Okay, so that is pertaining to uh, an important point. Now we want to focus a little more on something called as directly attributable expenses. Site restoration we will study tomorrow. So when you look at directly attributable expenses, the standard tells you around 4 or 5 items, and it tells you loud and clear that I will not treat as a directly attributable expense. Now you can cry your lungs out or you can shout, but the standard, it is written in the law, not just by the ICI, it is written in the bare text. These are 4 to 5 items which will never form a part of directly attributable expenses. Earlier there were certain gray areas. So some people might say this is a part of cost, some might say it is not a part of cost. So that is why Institute gave you clarifications. Now what are those items? First, so they are saying directly attributable expenses. These are expenses directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in a manner intended by the management. So a lot of high level English being used. In simple words, this means all expenses incurred to get the asset in the ready to use condition will be a part of directly attributable expenses. The following items highlight this will not be considered as directly attributable. What are those items? First, inauguration expenses. Any kind of inauguration expenses, like for example, you are constructing a particular machine and at the end of its construction, you get someone like a Deepika Padukone or a Ranveer Singh to kind of inaugurate. They will charge you a bomb. Will that increase the cost of your machine or increase the cost of your building? No, it's more of a publicity stunt. In which case, you will say this is selling and distribution. It cannot be going into the cost of the asset. So any kind of inauguration expenses cannot be a part of cost. So that is one part. So what is the gray area, sir, over here? Sometimes what will happen is we as Indians are very religious. So over here, we say forget Deepika Padukone or Ranveer Singh, we will call Pandit Ji. So we will call our Pandit Ji just before the start of construction. Pandit Ji will do Bhumi Pujan, and once Pandit Ji does the entire puja, is only when we will start construction. So this is also an inauguration expense. So someone can argue that without Pandit Ji's approval, we would have never started construction, and hence Pandit Ji's cost should be added into the cost of the asset. Ind AS says we will not differentiate between Pandit Ji and Deepika Padukone. We will say that, well, all of these expenses, whether it is for a Bhumi Pujan inauguration or it is for an general inauguration, they will be inauguration expenses, will go to the profit and loss account. They will not be added to the cost. Are we clear with this? So any kind of inauguration expenses will not be considered to be directly attributable and they will be taken into the profit and loss account. Second, losses and expenses incurred after the asset is in the ready to use condition. So sometimes what might happen is the asset is ready for use and after that you are incurring expenses, that is subsequent expense, cannot be added to the cost initially. Or certain losses, like I don't know whether you remember or not, this was, I think, before you got a phone, I'm not sure. Jio started its operations somewhere around 2017, 16, 17, 18 or so. And at that time, they were giving free connections. So when I look at the Jio's telecom network, the optical fiber network, etc., it was ready for use. However, they were not charging anything from the customer because they wanted to build up a customer base first. Now one can say that I spent 10,000 crores to build the optical fiber network. Next 2 or 3 years, I made losses while I kept on acquiring customers. I gave them free connections. Will those losses be added to the cost of the telecom network? The answer is no. Why? Because the telecom network is ready for use. Now, whether you charge money from your customers, don't charge, incur a profit, incur a loss, the law does not tell you that capitalize all expenses till the time the asset becomes profitable. No, they say the capitalize till the time the asset becomes ready for use. So over here, the asset, that is a telecom network, was ready for use. You incurred losses. Maybe that gives you future benefits later. Again, the law does not say cost includes any item that gives you future economic benefits. No, it includes only those items which are incurred till the time the asset is in the ready to use condition. So any kind of losses or expenses after the asset is ready for use will not be capitalized. It will be taken to the profit and loss account. Secondly, third is any kind of training. This was a highly debatable thing. Like if let's say I was if I was maintaining books manually, now I say everywhere there is technology, let me bring in laptops and let me use that for my processes. Now I buy the laptops, but my staff does not know how to use the laptop. So I do a staff training for using the laptops from NIIT or some Aptech or some coaching institute, and I pay them expenses to train my staff so that they can use the laptops. Can I add the cost of the staff training to the cost of the asset? The answer is no. Why? Because the laptop is ready for use. You don't know how to use the laptop is a separate story. Now, what applies to a laptop also applies to any kind of training expense. Like, for example, if I were to buy a flight, an aircraft from Boeing, now my pilots need to know how to operate that aircraft, and hence I get a training of my pilots from Boeing. Now, the aircraft is ready for use. My pilots don't know how to use it. Does not increase the cost of the aircraft. So, any kind of staff training will now go into the profit and loss account. Okay. Cash discount is a generally accepted accounting practice. I have not formulated it. See, remember, when you have done your 11th, 12th, everywhere cash discount was linked to early payment, and hence they said it has to go to the P&L. Ind AS 16 goes with that same flow. If I become a standard setter, yes, I will take your point and say that cash discount also is going to reduce the cost, but till that time, cash discount will go to the P&L, trade discount will reduce the cost. So over here, cost of staff training or operating in a new environment or a new set of customers. So any kind of training cost will not be added to the cost. So what are the three items that we have studied till now? Inauguration, losses or expenses after the asset is ready for use, and staff training. These three items will go to the profit and loss account. Fourth is relocation. What do you mean by relocation expense? I mean, I'll give you a hypothetical example. Any expense that is incurred to bring the asset in the location and condition as decided by the management will be capitalized. But that is not called as relocation. That is called as an expense to bring the asset in the location and condition as desired by the management. So let us say I want an AC. I buy an AC. So the expenditure to bring the AC to my, let's say, factory will be capitalized, definitely. But let's say this AC is very special to me. So wherever I go to take the lectures, I remove this AC hypothetically and I take that AC along with me. In which case, and I install it, I am doing a Bharat Darshan with the AC. I am relocating this into a different location and condition. Will I keep on? I may say, though, oh, I am getting more students because of this AC, which is very auspicious for me, whatever be the reason. What do you guys think? Should that cost be capitalized? The answer is no. Why? Because it is relocation. The asset is already in the location and condition as desired by the management. For whatever reason, the management decides to change the location and condition. That will not keep on adding to the cost of the asset. That will go to the P&L account in general. Basically, it is a subsequent expenditure. If it's a subsequent expenditure which can show to increase the life or efficiency of the asset, then you can capitalize it. But if it does not increase the life and efficiency of the asset, even under subsequent expenditure guidance, you cannot capitalize it. By no means can you say that initial recognition, I will capitalize. No, that AC was ready for use. You shift the AC at 20 different places does not mean you keep on increasing the cost of the AC. Again, in all of these cases, if let's say like this point B, losses, expenses after the asset is ready for use. So if you are doing certain expenses after the asset is ready for use, it will never form a part of the initial cost of the asset, but subsequently if it increases life or efficiency, then you can capitalize. Similarly, relocation, if it increases life or efficiency, you can capitalize, but otherwise, in general, by default, any kind of relocation expenses, relocation means the asset is already in the location and condition as desired by the management. It cannot be added to the cost. Are we clear with this? So what are the four items? And the fifth one is what we have already discussed: administrative and general overheads, even selling overheads. Administrative, selling and general. General means it is not directly attributable. So the standard says that there are 5 items which will not be taken as directly attributable expenses, and hence they cannot be added to the cost. In fact, they will be taken to the P&L. Which are those 5 items? Inauguration expenses, losses and expenses after the asset is ready for use, any kind of training expenses, relocation expenses, and administrative, selling and general expenses. These are not treated to be directly attributable and will not form a part of the cost of the asset. Are we clear with this? Okay. This is regarding directly attributable expenses. Now there can also be directly attributable incomes. Listen to this carefully. There can be directly attributable incomes. Sir, how can there be a directly attributable income? Like for example, you want to construct a building. Like in a redevelopment project, there's already an existing building. You are planning to demolish that building, and in place of that building, you are planning to construct a new building. Think and tell me, will the demolition cost to demolish the existing building, will that be a part of the overall cost of the project? The demolition expenses will be a part of the cost. Yes, because it is necessary to construct the building. Okay, when you demolish, you get some debris, you get some scrap, and you sell that scrap. So what you do is you incur 100 rupees of demolition cost, and on demolition you get some scrap which is worth, let's say, 30 rupees. What do I do with that 30 rupees of income? Will I take it to the P&L account? Well, that 30 rupees of income is directly attributable to a cost of construction. So I have spent 100 rupees to demolish, and I said that that is a directly attributable expense because that is necessary to construct the new building. But my overall cost is not 100. 100 I'm spending and 30 I'm recovering back. And hence my net cost of construction will be, let us say, 100 minus 30, that is equal to 70. That 70 will be the net cost to be capitalized. Are we clear with this? Okay. Next. Okay. There can be other examples as well. Like for example, if you have seen movies, a lot of these movies, you see the climax scenes where the hero and the villain is fighting is almost always in a under construction building. Let's say you're constructing a building which is still under construction. Someone like S.S. Rajamouli or Rohit Shetty passes and they say, oh, this is a very good building, it is in a very bad shape and I can film my climax over here. They approach you and they say that we want to kind of use this site and we'll pay you, let's say, 50 rupees for using this site, let us say. So you allow them to use the site and you get an income of 50 rupees. Is that income of 50 rupees directly attributable to any cost of construction? Or should it go to the P&L? So the law over here says directly attributable expenses, like they are capitalized, incomes which are pertaining to that will be deducted. But if expenses are not directly attributable, they're not capitalized, they're taken to P&L. Like income is also not directly attributable, they will be taken to the P&L account. What do you guys think? If, let's say, I give out my under construction building for some, let's say, movie, will that income go to the P&L or it will reduce the cost of the building? Well, it will go to the P&L. It is not directly attributable to a cost of construction. And hence it will go to the profit and loss account. That is right. The same logic even applies for an entity earning rent from, let's say, a vacant plot. Like I'm constructing buildings, I've taken a big plot of land, I've constructing it in phases. So I'm constructing some towers in the first phase, the other part is vacant. I give that area out and earn some rent by allowing cars to be parked over there. So that income is not directly linked to a cost of construction, and as a result that will go to the profit and loss account. Okay. Similarly, another example which is quite interesting is, let us say I'm constructing a asset, a machinery. However, I want to test it. Remember, before I say the asset is ready for use, I may have to do testing. So I'm doing certain pre-production testing to ensure that the machinery meets specified parameters or not. What do you guys think? Will that testing cost be capitalized? Will that testing cost be capitalized? Well, yes, it is necessary to get the asset in the ready to use condition, and hence the testing cost will also be capitalized. However, when you do this testing, the machine on the machine, the testing, you are doing a test run. So the machine manufactures certain products. You want to test those products. So you incur the testing cost, but those products you want to now give it to certain people. So let's say in the village in which your factory is operating, you want to kind of those test products, you want to give it at a concessional price. So you incur 100 rupees of testing cost, got some products and you sold those products, for example, for 30 rupees. So what will I do with that 30? Will that 30 go to the P&L account? Or will that 30 be deducted from the testing cost? What will you do with the 30? Well, this will be deducted from the testing cost because it is directly linked to testing. So when I say that, okay, I'm incurring 100 rupees for the purpose of testing, minus 30 I'm recovering, and hence the net 70 testing cost. So long story short, directly attributable incomes will be deducted from the relevant expense, like a demolition expense, like a testing expense, and the net expense will be taken for the purpose of capitalization. If the incomes are not directly attributable, like a car park rent, or for example, rent by giving an asset out for a movie shoot, they will be taken directly to the profit and loss account. Okay, so this usually is understandable by most of the students. Now there was an amendment, I think 1 or 2 years back, where the institute has specifically mentioned about a specific case. Now, is it possible that you are constructing an asset or you are demolishing, whatever it is? So let's say there is a demolition cost, or let us say there is a testing cost. And then on demolition, you will get some scrap which is directly attributable, or on testing, you will get certain output which you are selling. So let's say you're incurring 100 rupees of demolition or testing cost, and then you are getting some income from selling the scrap or selling the products. There'll be some other construction cost as well, like there'll be materials, there'll be labor, there'll be overheads, there'll be a lot of other cost as well. Like let's say this is worth 1000. We said 100 minus 30, that is net 70 you will add, and hence 1070 will be your cost. Does that make logical sense? Okay. However, what if instead of 30 you sell the debris and you get 130, or you sell the products and you get 130? Is that possible? Is that possible? Okay, now what do? If I deduct 130, you have two options. Either you show this net negative 30 and this comes to probably 970, or you say 100 minus 100, that is equal to net 0, and the 30 you take to the P&L account. What do you guys think? The standard has told you what has to be done. Most of the students make a mistake over here. What do you guys think? What if your income, directly attributable income, is greater than the directly attributable expense, like the demolition cost and sale of scrap, or testing cost and the sale of products? What do you guys think? So I can see your answers as 970, and that is impressive. That is correct. The standard over here, at least Ind AS over here, has very clearly said that the treatment has to be consistent. If my demolition cost was 100 and my sale of scrap was 30, both of them were directly attributable, the net 70 is my cost. But if my demolition cost was 100 and I'm able to recover, for example, 130 out of it, then that net 30 reduces my overall cost of construction, and hence you will take it as 970. That is absolutely right, and that is quite impressive. Most of the students that I've seen ultimately end up saying that we will deduct only 100, 30 will go to the P&L. That is wrong. Institute has very categorically mentioned that that is not correct. You will have to deduct the entire amount, even if it is negative, so be it. So over here, incomes from asset. incomes from asset should be taken to P&L in case they are not directly attributable to the cost incurred to get the asset in the ready to use condition, like the car park rent or the movie set example. Or in case incomes are directly attributable to construction, they should be deducted from the cost of the asset, like sale of samples from pre-production testing, or maybe demolition cost and subsequent sale of scrap. Special case, in case the sale proceeds exceed the testing cost, like the sale proceeds 130 exceed the testing cost, let's say 100, then the excess, that is the net of the net sale proceeds of the items produced over the cost of testing, should not be recognized in the statement of P&L but deducted from the cost of the PP. So that net 30, 100 minus 130, so that net 30 should not be taken into the statement of P&L. Instead, they should be deducted from the cost of the asset and the net amount will be shown. Is everyone clear with this? Okay. And the last part, okay, and we'll probably then jump onto the questions, but for now, the last part over here, we'll do site restoration, etc. in tomorrow's session. Is what about losses? Well, we have heard about this concept in costing that if there's a normal loss, what do you do with the normal loss? Normal loss is added to the cost. What do you do with the abnormal loss? Well, abnormal loss is taken to the profit and loss account. So when I look at the concept of losses, well, there can be a normal loss. Like for example, if I'm constructing a road in, let us say, areas like Leh, Ladakh, Spiti Valley, where there is a lot of landslides, I believe that usually it will take me 10 crores to construct a road. However, there will be a lot of landslides and I normally expect to incur 10 crores plus a 5 crore loss and hence 15 crores. So that 5 crores, when that normal loss happens, will be added to the cost. So I will say that it costed me on an average 15 crore to construct this patch of road. However, if you're constructing this road, let's say in a Chennai or a Mumbai or let us say a Hyderabad, where you are saying that usually there's no natural calamity, so I believe that will be 10 crores. However, there is some unfortunate event and you incur a 5 crore loss. Now, this is an abnormal loss. This will be taken to the P&L. I will not say that my road now costed me 15 crores. No, the road costed me 10 crores. The cost of the PP is 10 crores. 5 crores will go to the profit and loss. A generally accepted cost accounting practice is that normal loss should be added to the cost, whereas abnormal loss should be taken to the P&L. Now, what is the problem? If the question tells you that there was a loss of 5 crores, they don't tell you whether it is normal, they don't tell you it is abnormal, then what do you assume? Well, the institute, if nothing is given, assumes the losses to be abnormal. So over here, if nothing is given, we will assume that the loss is abnormal, because if it is normal, the question is to tell you that the management expects this loss in the ordinary course of business. If the question does not tell you that, then we will assume that the loss is abnormal. So over here, if there's abnormal loss should be expensed to the P&L, whereas normal loss should be capitalized. Unless given, losses or wastages are assumed to be abnormal. That is, if nothing is specified, the loss will be treated as abnormal loss. Yes, wherever there will be a difference between IFRS and Ind AS, we'll definitely try to mention it, though from an FR paper perspective, that is not relevant. You only need to look at Ind AS. Okay, so I believe that should be it. We have had a fairly long session for the first day. I think over the next few days, you will get accustomed to it, but I guess that should be it. I hope you have had a productive session, and if there are any queries or doubts, please put this down on the chat box. We'll do another lecture tomorrow on YouTube only, and then we will shift to the app. We will share the access details for the app in today or tomorrow, and if there's any problems, you can connect with the team for the same. So that should be it for the day. Wish you a good day. Revise whatever has been done. Ensure you have this daily habit of quickly touching upon, glancing upon what we spent in 3.5 to 4 hours. You should be able to quickly cover this. You'll be surprised if you do it on the same day in easily less than an hour, around 40-45 minutes you spent, and you'll be able to fully absorb whatever has been done. So ensure you be a little more proactive and complete everything on a daily basis. For every 3.5 to 4 hour session, if you dedicate another 45 minutes to an hour, you are on speed, and that is where your understanding will settle in. Here I will construct the entire framework for you, but if you are able to devote that less than an hour each day, you will see the magic unwind. Okay, so ensure you kind of touch upon this before tomorrow's session, and we'll continue tomorrow. Do we need to refer the ICI material? Not needed. If you want, you can do it at your leisure time, but from an exam perspective, this is exhaustive. You don't need to refer anything else. Bearer plant, I've spent a lot of time explaining. What do you not understand in bearer plant? It is a bar plant which bears aggregates produce, like it's a coconut tree bearing produce, and it has a life of more than 12 months. That's it. I've given you many examples, and what is the point that is not clear? If you can help me with that. Bearer plant is a plant which bears produce, like coconut tree, apple tree, mango tree. They will bear a produce, and they're not produce themselves. Like a bamboo tree, bamboo itself is a produce. Teak wood tree, teak wood itself is a produce. That's about it. There's nothing more in that concept. There are WhatsApp groups and Telegram groups where I'm also there, so you can put it over there. There are query solvers as well. Radiation plant related. What is a radiation plant? I'm sorry, I'm not able to understand what do you mean by radiation plant? Bearer plant just means there's a plant which is bearing its produce, and if it does not bear any produce, if it itself is the produce, then it is not a bearer plant. That's about it. Any other questions or queries, anyone? Okay. Perfect then. So that's it for today, and we will continue tomorrow. Pineus radiata. Pineus radiata, will do an exact sum on this. I mean, I just gave you as a passing reference. It is just Pineus radiata was a tree which was used for the purpose of construction. So in that case, it is not a bearer plant because it itself is a produce. The tree will be grown like a bamboo tree. It will be chopped down, and the logs will be used for the purpose of construction, in which case it is not a bearer plant. But we'll do that. That exact sum is there in agriculture. I've just given you a passing reference. Okay, then can I stop the session? Perfect. Have a good day. Revise whatever has been done, and I'll see you tomorrow. Have a good night's sleep. Revise stuff, and we'll continue this session tomorrow. Have a good day. Bye bye, and take care.